Up by 0.1%. We'll see how the rest of Europe opens. We are, though, still arguably waiting for that critical moment a little bit later on 7:30 Eastern when we do get the CPI print in the United States dropping. That will probably determine ultimately where many of these markets are going to close. The IBEX is up by 0.3, the CAC is up by 0.3 as well. What are we looking at, Tom, Lizzie, in terms of the sector story, the single stock story? We'll get on to gilts in just a moment as well.
Well, Guy, at the moment you've got all sectors in positive territory bar two. So tech and healthcare bottom of the basket today. Real estate leading the gains, higher 1.2%. Are we seeing a bit of a read through maybe to tech from the chip story over from the US? But it's mostly green across the screen. And as you say, across the continent, the FTSE 250 actually the most optimistic this morning, Tom.
Let's get to the gilt move then. You are seeing a bid for UK sovereign debt right now. So there's the calming balm for Rachel Reeves, at least for now, with yields down 8 basis points at the front end, with the 2-year yielding 4.52, and it is bid along the curve as well towards the back end. The 30-year is now at 5.38, yields down 7 basis points on the 10-year. The benchmark now at 4.80, now at 4.80 on the 10-year, with yields down 8 basis points. The pound again rallying at 122. Guy,
the two, you can understand the connection. I come back to the point that maybe foreigners are buying gilts this morning. Certainly see evidence of that. You look at what is happening elsewhere across the continent. Bunds down by 3 basis points this morning. You've got gilts down by 8 basis points. So maybe there's just a bid coming in. Maybe that just increases the bid coming through and therefore for sterling. But we come back to kind of how long is this going to be sustainable? In terms of what this means for the FTSE 100, what is interesting here is that you are seeing the FTSE 100 bid up by around 0.6%. You would have thought normally sterling goes up, FTSE goes down, but that doesn't seem to be what is happening this morning.
No, indeed. But if we think about the inflation picture, well, let's look at some of the movers that are moving this morning. If we could just bring those up, some of the biggest movers today. National Grid higher 1.9% in the green there. ASML at the bottom of the basket, though, on the board there, down 0.6%. Hermes suffering, down 0.9%. LVMH as well, down more than 1%. So luxury suffering today, Guy.
But oil stocks are higher. And that's off maybe the oil story we were talking about a little bit earlier on, to the sanctions story and what is happening coming out of the EU. So you've got Shell tracking a little higher this morning. You basically got UK banks and UK oil companies both rallying. So Lloyds is up. You've got Nationwide up. You've basically got UK banks looking, NatWest is up as well. UK banks are looking fairly favourable. BP's up. Shell is tracking a little bit higher as well, which is interesting given the sterling move, but the oil move is positive. And then GSK, big foreign earner, actually tracking a little bit higher as well.
Some of the
moved lower yesterday.
Some of the retailers in the UK that got badly hit last week are seeing gains. So Kingfisher is up 2.4%. You're seeing gains for B&M. Next is also up 1%. And JD, which has been under pressure, is currently gaining 1% as well. But how long will this upside be when it comes to the UK as we moderate around the views on inflation? Again, markets now pricing in 2 rate cuts for the Bank of England.
OK, so temporary relief here in London off the back of that softer than expected UK CPI print. But of course, all eyes now on US CPI coming later today. David Costin, Goldman Sachs chief US strategist, spoke to us yesterday with his view on the path ahead for inflation and of course the impact on markets as well.
Our expectation is that inflation is coming down slowly, and that bond yields will fall over the rest of this year, something closer to 4.25% on nominal yields, down from the current level, which is much higher than that. So I'd say that's a big area of focus for fund managers.
Okay, joining us now is Sharon Bell, Senior European Equity Strategist at Goldman Sachs. You heard the view there, Sharon, on the US. When we think about the UK this morning, the data dropping, are you of the view that this is going to be short-lived, that the problem is actually going to continue?
Look, the UK obviously has some problems. It's got twin deficits. It's got trade deficit, it's got a fiscal deficit, and these are very tricky things to tackle, and they're not going to be miraculously cured with one inflation print. That all said, it is good news that inflation is moderating a bit, because it does just give the Bank of England a little bit of room to cut interest rates. We expect them to cut at the February meeting, and the market is now pricing in a little bit more cuts for this year, and that is some relief to the UK economy.
Yeah, the market agreeing with you. In terms of the US, even if the data is a relief now, even if that draws out more stock bulls now, I wonder, can it last, given all the uncertainty on inflation in the US picture?
Yeah, and look, oil prices have risen recently, and that obviously is one of the big triggers that we saw in the last couple of years to higher inflation. So we obviously are looking at that. But we generally think that inflation from these very high peaks that we had a year or two ago has been trending down and will continue to trend down. Central banks like the Fed have been cautious in their cutting cycle, partly because they know that the economy is reasonably strong in the case of the US. They want to cut cautiously, so reflecting this idea that the labour market is pretty strong, the economy is not particularly weak in the US. And when it comes to inflation, it's driven by things like global goods prices, energy prices, and they are down a long way from where they were a couple of years ago from their very heady highs. So we do think inflation is moderating. That will help bond yields ultimately come down. But the path is never a linear one, straight down. There will be bumps along the way.
So to protect on those bumps, where are you looking for downside protection if you do want to be adding in an environment of still high yields?
Yeah, I mean, certainly you can look at downside protection in places like gold, for example, and a lot of people go to gold because it's a safe asset. It's one that does a little bit better when you see risks rise like we've had recently. So I think that's potentially one place that you could consider. Another place that you can consider is, and people have done a lot of this in recent years, is to look at US stocks, which are kind of not just the Mag 7, those core companies, but kind of broadening out your exposure to the US as well, so that you are not sort of concentrated in terms of your risk. So you can try and look to do that. The other place, I would argue, is that, the safer parts of the bond market where yields have already gone up now and offering you quite a good yield. So we're actually, within our asset allocation, overweight both equities and government bonds, underweight credit, which we regard credit spreads as super narrow at the moment, but bond yields at these levels we would see as quite attractive bonds.
Okay, so you're buying bonds, and which parts of the equity space is most attractive at this point? Because the relative value, the nominal value question that we were talking to Sebastian Redler about yesterday, how do you balance the kind of the relative value story for Europe?
Yeah, look, it's a tricky one. We still actually think the US will deliver better returns than Europe over this next year, but it's a closer call than it's been, I would argue, in the last year or so, because Europe has already underperformed a lot, and the US equity market trading on a PE of about 22 times is towards the top end of its range. So the US trades at a high valuation, but we do think, all other things equal, we have an environment where inflation is gently moderating over time, albeit a bumpy path. Yields will eventually reflect that and come down. And with the Fed still in a cutting cycle, even if it's not as sharp as many people hope for, no recession in our forecast, that's all quite good for risk assets like US stocks.
So we talked to Sebastian Redler from Bank of America yesterday. He thinks that if the US markets fall by 10%, say the S&P goes down by 10%, he thinks the European markets go down by 5%. Is that your view as well? Do you think what's the beta here?
Yes, I probably do agree with that. Historically, you'd say Europe tends to correct more than the
exactly.
US. So you wouldn't want to go into Europe. But I think that if you look, for example, in summer of last year, when you saw a tech-driven correction, Europe and UK, for example, which has very little tech exposure, barely fell at all. So I do think the US has got certain vulnerabilities because of the concentration of returns in recent years in 5 or 6 companies, and because of the high level of valuation, that does make it a little bit vulnerable to a correction. We don't necessarily see the big triggers over the next 6 months to that, given that you've still got inflation coming down, in our view, rates coming down, reasonable economic growth. None of that would suggest to us that you see a very large correctional bear market, but the risk, of course, is there.
Would parity on euro-dollar be a trigger for US investors to think more seriously about investing in Europe?
I don't know about that. The problem is the way you get parity and a lower euro or a lower sterling is normally because risk events have gone up in Europe.
Sure.
People are suddenly worried about France. People are suddenly worried about the UK.
But you've got a super cheap currency. You're a US investor, that's already in them. So you've got that.
Yeah.
You've got super cheap valuations. Like, what is the catalyst?
To get US investors interested in Europe. Look, actually, US investors' flows into Europe have been okay in recent years. It's European investors that aren't buying Europe. They're the ones
buying America,
deserting Europe and going off and buying the Mag 7 and the US. So it's those ones that we need to retain in Europe. I mean, absolutely, it's helpful if global investors buy Europe, but I think it's more, we need more domestic bid.
It was interesting this morning, we heard from the ECB's Philip Lane at some ungodly hour speaking, but he was saying that the central bank can't ignore the currency story forever, but it's companies that will absorb it first. But when you think about the broader picture geopolitically, we haven't talked about Donald Trump yet. Yeah. Is it actually the UK that becomes more attractive here because it's kind of shielded from the impact on China and the EU directly because we're not such of a threat in terms of goods trade with the US?
Yeah, I mean, we have been arguing this. I very much agree with that. The UK isn't an economy which is dependent on global trade and manufacturing in the same way as, say, Germany is, which is super exposed both to China and super exposed to the US in terms of goods trade. The UK is much more services, much more finance, etc., and they're less impacted by tariffs, so completely agree with that.
If you want to fade UK risk, you have a call on FTSE 250 on the small mid-caps. Just unpack that for us. Yeah. I mean, how much conviction do you have in that view?
Yeah, look, it's always a more risky one, isn't it? Because FTSE 250 is quite high beta to all these UK events. But I do think, I mean, our view on the Bank of England is that the bank's got too cautious a view on cutting rates at the moment. Their view on UK growth this year is probably a little bit too high. As that starts to moderate through this year, it will give more room for them to
Two cuts is still too cautious, do you think, for the BOE?
We've got quarterly cuts for the Bank of England. We think that this recent events made us even more of the view that they would cut in February. All of that will be supportive of the 250. But, I don't disagree. There are lots of risks involved in this.
Are we about to see taxes going up and all kinds of factors which are likely to hit the domestic economy more? It's either taxes go up or cuts get priced in terms of the spending from government.
Yeah. So there are, taxes are going up, although a little bit of spending is going up as well,
sure.
Which adds to UK economic growth. So, look, on balance, I think it's a combination of us thinking that there's a lot of risk already priced in into UK assets generally and into the FTSE 250.
That's been like that for ages.
Specifically. Well, yes, except even more so now. But then I guess you could argue risks have indeed gone up in the last couple of weeks, which I'm sure that they have. But valuation is low, a lot of risk is priced in, and I wouldn't be in the camp that you see a recession in the UK.
It's great to see you, Sharon. Thanks for stopping by to see us around the table. Thank you very much indeed. Sharon Bell, Senior European Equity Strategist, joining us from Goldman Sachs. Let's take a quick look at the centre of gravity here in Europe. This is what the Core 6 looks like in terms of the major stocks that we track. As you can see, Schneider's the only one higher. Lilly got hit really hard yesterday, and that move looks like it's continuing into Novo Nordisk. Eli Lilly under real pressure in the US session, but LVMH continues to drop. Ferrari's a little softer as well. Even Nestle, one of the safest stocks in Europe, though you could argue not over the last year, is down by 0.2%. What else are we watching? Joe Easton, over to you.
So we are seeing some movement in these testing at stock Sky. Remember, SGS and Bureau Veritas confirming that they are potentially looking at a deal for a takeover. We can see Veritas coming up around 4% at the moment, and SGS going the other way, potentially reflecting the amount of money that may have to be paid out on that deal. SGS has been the underperformer, and it does look to continue at the moment. But interesting news in that space. There's a couple of other stocks moving on that, including Intertek in the UK. I saw that one edging up. Then in terms of the UK mid-caps, as Sharon was discussing there, it's all about the rates outlook. We are seeing yields coming down on the gilt yields pretty significantly this morning, and therefore that is feeding into the home builders, in particular Persimmon, also Vistry. Both of those stocks coming up. I think Persimmon also upgraded over at Deutsche Bank as well, potentially helping the outlook on that one. Hayes, meanwhile, gives an update. Weakness in the UK employment market, but we've already seen a lot of that coming through from the likes of Page Group, Robert Walters as well. So potentially this is actually priced into the market, and we're seeing that stock coming up. And then the big one, Curry, selling loads of TVs and dishwashers, because that stock coming up 11% following a Christmas trading update. The profit guidance looks pretty firm on the Currys for that stock at the moment on that one. Then in terms of the other shares on our radar, we were looking at Ubisoft because, of course, that news around a potential asset deal, a joint venture deal with the Tencent and founding family of the company, edging up 1%, but still down heavily over the past year for that one. Meanwhile, Bayer paying out $100 million to a group of workers at a school in Seattle, but potentially that was not as bad as some people had expected. It does point to billions of potential compensation payouts for the company related to their Monsanto unit, but that looking like a little bit of relief from that verdict, although $100 million does sound like quite a lot of cash. Then in terms of rating changes, Air France, that one did get a downgrade. That was over at Barclays, and we're seeing that reacting. It is underperforming, down 0.4%. Underweight on Air France. They've had some issues, of course, around the fuel costs recently. That has weighed on the sector, potentially playing into that one. And the other one on my radar was here in London, Anglo American. This one also had a rating change. That was over RBC. Of course, the outlook pretty much dependent on China for that one, but their price target, 2,200 pence, still some significant downside. Anglo coming down 1.8%. Another stock moving here in London this morning.
Joe Easton from our equity team, thank you very much indeed on some of the stocks on the move. Let's get back to what is happening with gilts before we take you to the break. You are seeing money moving into UK sovereign debt. On the benchmark 10-year, yields are down 7 basis points at 481. At the front end, yields down 8 basis points, 452, as traders ramp up expectations for another cut in February. Coming up, the US doubles down on China chip export restrictions. We're going to look at the implications then for the producers, including TSMC, Samsung and Intel. That's coming up. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. We are 19 minutes into the Wednesday session. We've had the inflation data, more benign out of the UK. We build up to the CPI print of the US, of course. European stocks are up 0.2%. You're having a decent session here in the UK with the FTSE 100 up 0.6. The DAX over in Germany up just a tenth. Over in France, though, bit of softness, down 0.1%. Let's get to what's happening in terms of further restrictions on chip sales into the Chinese market, because the US is planning new regulations to stop China getting hold of advanced chip technology. The latest measures are expected to put the onus on chip makers themselves to carry out more due diligence on their customers. For more, we're joined by Bloomberg's Bill Ferries. Bill, what is the prospect then? What is the rationale behind these measures? How much more complicated does it make it for the foundries looking at those Chinese customers?
Well, Tom, the goal here from the U.S. perspective is to stop the flow of some of these chips through third parties or backdoors to Chinese companies that are already basically blacklisted, like Huawei, for instance. So the new restrictions would target chips in the 14 to 16 nanometer range. That's a range that is not typically thought of as advanced chips, but there was some alarm when chips from TSMC were found through a third party to have gotten into Huawei technology. On the other hand, the U.S. restrictions would allow companies like TSMC, Samsung, Intel, if they do a certain amount of due diligence and know their customers' needs a little bit better, to allow them to continue selling into China. So the idea is to provide incentives for these major manufacturers to be able to continue their sales if they have done an additional few layers of due diligence on who exactly their clients are and whether those clients might turn around and sell their chips to other companies in China.
So a parting shot perhaps from Joe Biden. Another parting shot, the SEC filing a lawsuit against Elon Musk, Bill, over his acquisition of Twitter. The accusation that Twitter shareholders were done out of millions of dollars by waiting too long to disclose that acquisition. Is it a parting shot by the outgoing administration against Musk, or is it going to have real consequences?
Yeah, the SEC argument here is that Musk passed that 5% ownership threshold in Twitter in late March 2022 and then waited too long to disclose that to investors. In that time, he continued to buy hundreds of millions of dollars of Twitter shares that would have presumably gone for a higher price had they known Elon Musk was the main buyer. It's hard to know right now. There is going to be a much more a friendlier SEC chair coming in when it comes to big businesses and fines. The Trump administration is unlikely to want to pursue this, but it is, we'll have to see after January 20th whether this is something that Elon Musk really has to deal with, or it's going to be kind of a symbolic parting shot from the Biden administration.
Bill, great stuff. Thank you very much indeed. Bill Ferris on what is happening in technology. Let's turn to banking. Big day for global banking. Goldman Sachs, Citi, JP Morgan going to be reporting numbers. We're kicking off the earnings season unofficially today. The 5 biggest banks are expected to post a 50% rise in fourth quarter trading revenue. Let's talk about what we should be looking for in the details. Bloomberg's Charlie Wells joining us around the table. Expectations are high. The stocks have risen really sharply. Can they deliver?
Yeah, I think that's the question. Like, how much of this optimism that we saw in 2024 is baked in, and how much room is there to run for these bank stocks? The story last year was really good, and it kind of changed over time. So there was this expectation of of rate cuts. The rate cut came, there's an uptick in deals, then we got into the U.S. election, we saw all that volatility, and we are expecting to see some near record revenue for a lot of equities trading desks. So that's really positive. But I think going forward, does this continue? I think, analysts like Mike Mayo have been saying there's room to run. He said that, he's over at Wells Fargo, he said that, we're entering a new era for banking. But do recent trends in the markets pose more problems for banks in the year ahead?
Charlie, in terms of the language from executives on the calls with analysts, particularly around guidance, what are you and the team going to be watching out for?
So it's Trump, right? I think that's the thing that everyone wants to know about. And I think, after the election, there was this huge sugar rush for bank stocks because of this one word, deregulation. Bank stocks, I was just checking a few minutes ago, they're hardly up from the day after the election. So it kind of went up and then is now kind of down back to roughly where they were. And I think there's sort of two questions here on the year ahead. It's, what does deregulation actually look like? Can legislation, can rules change given the unpredictability that we know this incoming administration will almost certainly have? And then there's that market question of, do the policies that this new administration bring in, particularly tariffs, are those inflationary? Do those mean that yields are higher for longer, at least somewhat higher for longer? And how does that change the sort of uptick in the deal flow that we've been hearing about? But are there some positives there as well for things like net interest income?
Also, more talk of succession planning at BlackRock and JP Morgan. What do you tell us?
Yeah, Lizzie, this is really interesting. So, Jen Pipsack was named COO at JP Morgan yesterday. We heard that Daniel Pinto will be retiring at the end of the year. And then over at BlackRock, largest asset manager in the world, a senior executive is departing. Of course, last year there was also the departure of Salim Ramji, who went on to head Vanguard. And this is all kind of adding up to this issue of some of this is seasonal, right? You get a lot of arrivals, promotions, departures early in the year, but also generational, right? A lot of these founders, a lot of these executives are boomers. I hate to throw that word out there, but they're in their late 60s, early 70s. Many of them either founded these companies or over the past few decades have been transforming them into what they are today. It's hard to leave. And I think there's a lot of questions about the largest bank in the U.S., JP Morgan, the world's largest asset manager, BlackRock. What happens to that leadership in the years ahead? A lot of questions from investors on that.
Okay, succession in focus as well ahead of those bank earnings with the setup and the preview. Charlie Wells, thank you very much. Indeed, a line crossing just on the chip story that we were discussing a moment ago. The Dutch, the Netherlands, the government there to tighten export controls of semiconductor equipment. Of course, they are home to some major producers of semiconductor kit, including, of course, ASML. That stock down 0.4%, but pairing some of the heavier losses. This on the back of further restrictions being announced regarding and from the Biden administration, focused largely on TSMC, Samsung and Intel. But ASML a little softer, down 0.4%. The Dutch making some moves as well.
Coming up on the programme, we're going to talk to someone in a sector that's really affected by the inflation story here in the UK. Of course, we had that miss on CPI, traders adding to BOE bets. We're going to talk real estate next. Investors naming their top destinations for real estate investment in Europe. We'll find out if London can keep its title. So do stay with us for that conversation. Coming up next, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
30 minutes into the equity market session, 30 minutes into the gilt session as well, which is interesting given the outlook we've just got on inflation. Where that story goes to the UK remains to be seen. But at the moment, you do see a bit back into equities. Feels like we're in a holding pattern, though. You've got US CPI data coming out a little bit later on. That, I think, will determine ultimately where many of these markets are going to be closing. It is out at 7:30 Eastern. 1:30 London time, so look for that a little bit later on. We've also got some comments coming through from the ECB as well. The ECB's De Guindos talking about the outlook for the euro area economy. He's talking about it remaining weak. He is talking about the conditions being in place for growth to improve, but he's not exactly painting a positive picture when it comes to the growth outlook. And this is the problem that we not only see in the euro area, but also in the UK as well. You've got a growth problem. And that's going to be represented, maybe, Tom, as we see the GDP figures coming through tomorrow as well. 90 basis points of cuts priced for the ECB through the rest of this year. We focus, of course, on the UK as well as traders ramp up the bets around February. 86% chance now that you do get a cut from the BOE in February, given the softer than expected CPI that came out. 2 rate cuts now priced in fully for the full year 2025. So let's check in on the markets. And you are seeing moves into gilt. So some reprieve for the Chancellor, at least this morning. The 10-year is bid. Yields are down 6 basis points at the front end, a little bit more activity. Yields down 7 basis points, 453 on the 2-year, 483 on the 10-year. Bunds in focus as well, just given the spread versus OATs. The French political story shaping up as well. German Bunds currently at 263, yields down 2 basis points. And French debt 345, yields down 2 basis points. Bayrou getting a stay of execution, at least for now, in terms of an alignment with the socialists. How long that will last is in question. The US benchmark 10-year 477 as we build up to inflation data out of the US, yields down 2 basis points. Now to London and what is happening in the real estate market, where of course rates are central to the story as well. Again, and London coming top once again in a survey of the most attractive European cities for cross-border real estate investment. The research by CBRE has also found that investors expect the highest returns from the UK overall. Let's get more then on the findings from Chris Brett, Head of Capital Markets for Europe and CBRE. Chris, of course, we want to get into the details of the findings in the survey, but I do want to first start on the rate story, given it's front and centre for us right now. How much of a challenge is higher rates in terms of investment flows into real estate? How much pressure is there on the sector right now?
Well, I mean, we've seen that 2024 was better than 2023. We're expecting that to continue. Rates clearly have a very big impact on borrowing costs around real estate, and that balance between what the cap rate is and where the rates are is absolutely critical. However, with the ongoing price recovery and discovery, actually rates are accretive to many parts of real estate because of the market price movement we've seen.
Do you see some clear out in the sector on higher rates? I mean, something's going to break at some point if we get, so fine, we're pricing in 2 cuts from the Bank of England, but that's far fewer than markets had expected 6 months ago. Which parts of the market are looking most vulnerable at this point?
I would say that most vulnerable is certainly going to be around some of the secondary office markets that we've seen have real pressure. They've had real pressure over the last few years post-COVID. However, I think the flip side to it really is actually the occupational side that we're seeing with the strength of the leasing markets, particularly around some of the key cities around Europe and globally, is actually stronger than everyone's expecting, thus giving us a really strong platform for 2025.
Are Londoners coming back to work anytime soon? Is that going to, like, how big a feature of the landscape is that going to be?
Guy, good morning. I think that the return to office is becoming an overplayed story, particularly in mainland Europe. I have the benefit of travelling around quite a lot, both in Europe and globally, and I don't see many empty offices in the European markets, or certainly in Asian markets.
Compare London to Europe. Is London different? Feels different. I get the train pretty regularly, and it's kind of still busy Tuesday, Wednesday, Thursday. Monday's getting better. Friday's still empty.
But Friday was a day we never measured before COVID.
Okay.
Right? So I think that you feel the office is definitely full. I think that actually when you look at what's happening in the office market generally, and this follows through to actually the battle for talent, and you see how much corporates are wanting to invest in the real estate and actually give their talent pool the best possible place to work, and that is showing, as I just mentioned, a real impact on occupancy and the rental levels that we're seeing in that part of the
top
market.
end. So top end looks good. People want to come into top end. That market looks really solid.
Yeah.
Like, how much further does the spread get between top end and everything else? Does that divergence continue in 2025?
Look, I think that if you look at the last few years, you would say that the top 10% of any market globally, any office market globally, has been exceptionally strong, both from an occupational perspective and also from an investment perspective. I feel that is going to widen to the top 25% of the market, which still, I guess to your question, still leaves what is going to happen to the rest. And we're seeing an ongoing evolution of the change in office to other sectors, so whether it's student housing or residential, and that is an ongoing evolution we're seeing in real estate generally.
Chris, if we can talk about life beyond the office, Spain's been scuppering my retirement plans. They're planning this 100% tax, perhaps, for home purchases there for non-EU residents.
Yeah.
How much do you think that's going to affect house prices there?
Well,
property prices in general.
Well, I think, look, from a residential perspective, it's going to clearly have an impact. From when you look at it, take a step back and look at it more on a generic perspective and look at it from an institutional perspective, Spain is still a very favourable market for institutional and private equity capital. So whilst it might affect your specific retirement plans, I don't think overall it's going to have a big impact on the commercial and residential market in Spain.
And let me ask you about Donald Trump's impact in your world. We've talked a lot on the programme about how long ESG can survive in its current form with him in the White House. What premium are investors willing to pay for sustainable assets this year?
Well, I've sort of said it a couple of times now. I think really on the occupational side, when you're seeing how much rents are growing in the top ESG buildings in major cities around the world, we're really seeing a very strong premium compared to what it was pre-COVID. But in terms of other asset classes, it has less of an impact, but ESG is still a very important factor for both institutional and private investors across European real estate.
Chris, the UK government came out with their AI strategy this week. Part of that is around data centres. Has the investment and the commitments around data centres in the UK kind of run its course? Is there much further to go on that, or is that going to be the strategy going to prove catalytic in its own space? What is the demand around data centre build?
Yeah, I think the demand around data centre build is absolutely enormous. You had somebody on one of your programmes yesterday who was representing one of the big hyperscalers suggesting there was an 80 billion commitment to building data centres within that organisation. The challenge around data centres is around land and power, and that is the big next hurdle that I think the market needs to get over. But
has the government got the answers for those two challenges?
Generally, I don't think anybody's got the answers to those yet. All right, it's because the concentration risk is so great that actually unlocking that power is a real challenge for everyone.
In terms of the amount of investment you expect, how do you see the next few years working out? The UK has got to fix planning, it's got to fix the infrastructure, it's got to figure out what's going to happen with water. The ability to build in the UK, how problematic is it at the moment outside of the square mile, outside of the kind of the core centres when it comes to the office market? What else is happening outside of that space? Is there still strong demand to build? And what are the restrictions that are being placed on that? Is the market being throttled back at the moment by some of the issues you just raised with Tom?
I think that the UK planning system has a historic challenge, and it needs to be revolutionised. And that is not an impact on people wanting to build, right?
Yeah.
The desire to build is definitely there, but there is a difference between the desire to build and the ability to build.
That's a priority for Keir Starmer. Has he not done enough on that?
Well, you'll have to ask him that, I think. But it should be. It's been a problem for a long time, though.
You're being very diplomatic, but you're talking about an issue that has been that long-running problem. They've talked about, as Lizzie's emphasising, this has been a priority for the government, but it suggests you are not seeing material action on the ground yet from this government to really address those issues.
I think that's a fair comment. Yeah. Okay. Yeah.
Great to see you, Chris. Thanks
Thank you.
Glad to see us. Chris Brett, Head of Capital Markets Europe for CBRE. Coming up, VW braces for another tricky year with no new electric car models. We're going to bring you that story next. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to the opening trade. We are 43 minutes into today's session. European stocks a bid up 0.4%. You're getting some decent gains here in the UK with the FTSE 100, as you can see, up around 0.7%. Stocks are up in the UK, and bonds are getting a bid as well, with the yields down 6 basis points on the 2-year, 5 basis points on the 10-year at 4.83. Now, the EU's climate commissioner says tougher climate targets would give predictability to the auto industry rather than being a hindrance. He spoke exclusively with Bloomberg's Ollie Crook in Brussels.
This is a tremendously important industry for Europe at large. I think it employs roughly 13 million people in Europe. It is hugely important for our overall GDP, and we will go to great length. We'll do our utmost to secure that this sector has a very bright future here in Europe, full stop. Having said that, many in the car industry actually tell us at the same time that we need predictability, that we need to stick to the 2035 goal, and that we can be much more effective in helping them out in making sure we protect the level playing field, in making sure that the loading infrastructure that people need to drive from A to B is actually there. And frankly speaking, I think Europe should do a better job, and member states should do a better job in investing, that they need way more investments in the grid. So I think that package in the end is far more effective. Now, you're going to tell me that I didn't answer your question, and you want to know about the fines. I cannot yet say how that eventually will play out. But what I can say is that we had roughly the same situation, I think, in 2020, when just before the deadline, there were huge worries about how these fines would play out. In the end, only one company was fined, and it was only a fraction of what was anticipated.
So then what can we expect in terms of these fines? Well, how much money do you think we're looking at for these car makers?
What I think is here again, we should not look at this one-dimensionally. What we need to do is we need to make sure we have a dialogue with all the main stakeholders in this, again, tremendously important sector that we will never, ever let down. And that is precisely what Ursula von der Leyen is embarking on. Have a dialogue on all the necessities, also all the requirements, because make no mistake, various players in the sector have different demands. Some might like to change part of the regulation we have. Others are ferociously lobbying us to keep things exactly as they say, because they are saying, well, we already made the investments. So I think what we need to do is take the full picture, have that conversation with them in the weeks to come, and then come up with a long-term and short-term solution that is good for Europe and that is good for them.
And that was Wopke Hoekstra, the European Commissioner for Climate, Net Zero and Clean Growth, speaking to Bloomberg's Oliver Crook.
Okay, let's talk about 2024 and what 2025 is going to look like for Europe's biggest automaker. Volkswagen is facing another tricky year. Deliveries are at risk of slumping again, with its namesake VW brand actually having no new electric car models due out this year. Adding to that, software delays are pushing back key products. Bloomberg's global automotive editor, Craig Trudell, joins us for more. That sounds really bleak. That sounds like a company that's got its back against the wall. Is that really VW?
I think this is a case of stubborn issues for this company that for some years now they've been trying to overcome and really struggled to do so. I think especially on the software front, where you did actually have for a time a sort of a barrage of product come from this company. The VW ID sub-brand of electric vehicles, there was a lot of hype, a lot of hope for those cars. I think they came to market and really let a lot of people down, including Volkswagen's own customers. There was a lot of glitchy software. There were real issues with these vehicles that, to their credit, they've worked through some of those to this point. But I think the damage was done in terms of reputation. I do think that if you look at VW's electric models relative to the competition and think about how many of them they're going to have to sell, to go back to this conversation about fines and hitting EU climate policy goals, they had to sell an awful lot of them in order to avoid having to either get fined or pay, say, a Tesla to avoid.
Do we think those fines are going to really happen? Do we think those fines are the reality, or at some point is Europe going to have to look at its car industry and go, actually, progress is a little slower than maybe we anticipated?
I think it's really hard to say. I think there's absolutely going to be a sympathetic ear to the idea of what are we doing getting our European companies to take money out of their pocket and put it into the pockets of, you know, an Elon Musk or BYD in order to comply with our laws. On the other hand, this is a sector that is responsible for, you know, more emissions than you know, any other. Yep. And, you know, this is also an industry that you know, has really sort of dragged its feet and not been able to execute. And this has not been an issue of a lack of investment. It's been a lack of execution.
Are there lessons that VW could learn from Toyota? Or, I mean, Toyota has not gone full bore on EVs. The circumstances are different, obviously, the regulatory requirements in Japan. They've gone with a hybrid structure. Is that paying off for them? And will it longer term for Toyota?
I mean, I do think that, you know, if we could, you know, sort of turn back time and think back to, you know, rather than invest so heavily in diesel and bet on diesel, had Volkswagen followed the Toyota strategy of at least, you know, partially electrifying their lineup and doing so really aggressively, I think we have seen that absolutely pay off extremely handsomely for Toyota. I think even Toyota is now in a position where, you know, just the sort of conventional hybrids, the hybrids that do not plug in, will only take them so far. And so they do absolutely need to offer more fully electric vehicles. And they, too, are under some pressure, I think under a lot less pressure than a Volkswagen, in part because they are so much smaller in this region than Volkswagen.
I mean, you hinted at this, Craig, but, you know, on Monday we saw Tesla overtaking Audi in terms of global car sales for the first time. I wonder how significant that milestone is, whether actually what you're saying is these aren't company issues, that they are company issues, they're not EV issues in general.
Yeah, I mean, I think, you know, Audi has maintained its position at sort of higher end segments, and we've seen Tesla over the last few years really come down pretty substantially and become basically a true two-trick company of a Model 3 and Model Y. And you can get those now for, you know, 40,000 euros or less in some cases. Audi, of course, plays in much higher price segments, and so we're talking about two much more different companies than we maybe thought about a few years ago. But I do think it's really significant that a company held in such high regard that, you know, for a time was really competing head on with Tesla, has now fallen behind, and I don't think that you know, the Germans you know, can be particularly happy to see that development.
Is the Chinese market now closed? Basically, for some of these big European car companies, the EV lead is so substantial now from companies like BYD that catching up is going to be nigh on impossible.
I think one of the things that was really interesting yesterday when Volkswagen released its, you know, group deliveries for last year, they talked about you know, holding out hope for 4 million vehicles delivered in China again, you know, sometime in the next few years. That's going to be really, really tough. I think, you know, to reverse this trend that has been, you know, really universal across the industry. You've just not seen international car makers be able to maintain their position in that market, and in no small part because of, as you say, the electric vehicles from the domestic players are just that much better, more competitive on costs. I think it's going to be really, really, we're going to have to see sort of a fundamental shift in the way that these companies have been operating. And, you know, maybe we see Volkswagen take advantage of, you know, sort of working with, you know, an XPeng and learning from the locals and, you know, finding a way forward. But it's going to be
particularly on software, right?
Yeah,
I mean, the Chinese don't get software wrong in their cars, generally.
Correct. Yeah, I think that's generally the case when you look at least, you know, sort of the owner surveys, the work that's been done on, you know, just how different and how much better, and also just how iterative they are. Their ability to sort of on a dime offer new features and you know, scratch the itch of the consumer in China is far superior.
Well, it's a fantastic big take on Toyota. Craig Trudell, thanks for bringing it to us, and all the other moving parts in the car industry. We thank you. But we've got a busy day ahead of us. We've already had UK CPI still coming up. We've got at 10 a.m. London time Euro area industrial production numbers at 1:30 p.m. London time. Of course, US CPI. Then 7 p.m. London time, the Fed Beige Book, and later on today, Trump's cabinet confirmation hearings, including for Marco Rubio, the former US House representative, and John Ratcliffe as well. Later, Fed speak across from loads of Fed speakers, actually. Barkin, Kashkari, Williams, Anglesby all speaking in the afternoon UK time. And then on top of that, later in the day, we've got Wall Street earnings coming from Wells Fargo, JP Morgan, Citi, Goldman Sachs, BlackRock, all reporting as well. We have had that UK inflation number softer than expected and a reversal of the recent gilt moves. You're looking at the 2-year gilt yield lower 7 basis points at 4.5%, the 10-year yield lower 5 basis points at 4.8%. Bit of a relief, perhaps, for Rachel Reeves. Does it continue after the US CPI number later? Let's discuss now with Jamie Rush, Chief Europe Economist for Bloomberg Economics. Jamie, just talk us through what's behind this softer print on UK inflation. Is it perhaps not the end of the UK inflation story?
Well, so look, it was services inflation which dropped, right? And there are loads of different ways of cutting services inflation. You can do the headline rate, you can exclude things like airfares, which bounce it around all over the place. And so when you look at it, you see headline drops a lot, like core services dropped by quite a bit less, but still, move in the right direction. And if you look at the big picture over the past 6 months, you see that services inflation is kind of drifting into the sort of territory which is consistent with the 2% target. So big picture is that it's moving the right way. The Bank of England is going to be able to ease, and this, of course, means that Rachel Reeves will be able to catch a break.
And she probably will do, at least for 24 hours or so. Jamie, what is your expectations on BOE rate cuts then, as traders pricing now two cuts? Does that align with your view, or are you expecting more?
We think they'll do more. We think they'll do 100 basis points.
100 basis points.
2025, once a quarter. Again, reflecting that view that underlying inflation is coming down. We are going to see headline inflation drifting up a little bit over in coming months, but it's not going to be enough to trouble the BOE.
Gas prices are going up. Price fix is an issue. We've seen the BRC overnight talking about the food prices are going to be going up. They see that being passed through as well. Rents remain really elevated. The airfare story looks like maybe actually the survey period probably suggests that next time round we could maybe see a pop higher in that space as well. There's plenty of other factors, aren't there, creeping into the inflation outlook, which suggests that it's going to be a struggle from here. We were talking to Bloomberg a little bit earlier on, saying this is as good as it gets. It's going to get tougher from here.
There are some things that are feeding through. You're right about gas prices, but let's not get hysterical about them. They are not moving to levels that we saw during the energy crisis.
Sure, but they're up 50% year on year.
Yeah, but it's that is modest compared to, if you look at the level of gas prices, megawatt hours, euros per megawatt hours, pounds. It's really not moved anything like what we've seen in the past. So maybe gas prices and energy prices move up 1%, maybe 4% in April, maybe add 0.1 to inflation. This isn't something yet which is causing us to completely tear up the outlook. It's not of that order yet.
Do you think the risks are that we get that inflation is stickier than we think? The central distribution is, as you say, what you've laid out, but is the risk, which way is the risk on that?
So what have we learned over the past year? We've learned that inflation's been stickier than everyone hoped. You have to take something from that. But saying that, there are lots of reasons. When you look at the underlying gauges, as I mentioned, they are moving in the right direction. The big question really is what happens with pay. At the moment, people are expecting 4% pay gains. I'll be surprised if that's what materialises. But we'll see over the coming year. But if that will be the main problem if wage growth stays too high.
Jamie, great to catch up. Thank you for stopping by to update us. Jamie Rush, Chief European Economist for Bloomberg Economics. We've got a busy day coming up. 1:30 UK, you're going to see the CPI print out of the United States. We've got the CFO interview with Wells Fargo as well to catch up with as well. That conversation is going to be happening a little later on this evening, 8 p.m. UK time. Big US banks reporting day today. There's a lot going on. You want to stay tuned. The Pulse is up next. We've got a great lineup throughout the day. Enjoy the rest of the session, folks. This is Bloomberg.
from the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
UK inflation cools unexpectedly for the first time in 3 months as traders add to BOE rate cut bets, while markets now await US CPI data for clues on the Fed's path ahead. Now, the U.S. plans to unveil new rules to curb the flow of chips to China as part of a flurry of measures introduced in the final days of the Biden administration. And Elon Musk is sued by the SEC, which claims he cheated Twitter shareholders out of millions by waiting too long to disclose his growing stake in the company. So we'll have plenty more on the top stories, but there's quite a lot going on in the markets. Again, we're about 5 days away from Inauguration Day. Maybe we'll have more policy in the meantime. This is the picture across the board. European stocks actually edging a little bit higher. S&P futures also edging higher. There's a big UK story after that inflation figure. Again, British consumer prices rose from 2.5% from a year earlier. That's better than expected. So the print also sent the pound a little bit lower, and 10-year gilts sliding about 7 basis points. You can see the 10-year at 4.829 for the UK. We will talk shortly to the IEA, saying that oil surplus has narrowed for 2025 amid some supply risks. So that's a geopolitical, of course, conversation. We'll be joined by Toril Bozzoni, the IEA's head of oil markets division, in about 15 minutes from now. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Now, traders waiting on key U.S. inflation data out later today. We'll discuss that with Michael Strobeck, Chief Investment Officer at Lombard Odier. But first, technology and politics once again dominating headlines. The U.S. is planning new regulations to prevent advanced chips from being sold to China. Now, the SEC is suing Elon Musk for allegedly failing to disclose his growing stake in Twitter in a timely manner. Let's discuss all of this with Bloomberg's executive editor for Global Tech, Peter Elstrom, and our EMEA News Director, Roz Matheson. So thank you both once again for joining us. I mean, it's always tech and it's always geopolitics that seem to be dominating the news. Peter, what are the latest round of chip controls? And then how much does it tie in the next administration? Inauguration is next Monday.
It's almost hard to keep track. We're only a few days away from the new administration coming in, and you have the Biden administration rolling out new rules almost by the day. So the latest round of rules take a focus at companies like TSMC, Taiwan Semiconductor Manufacturing Corporation, which is the most important chip maker really in the world. They make the chips for NVIDIA and also for Apple. What they have been doing is they've also been crafting chips for a bunch of Chinese companies. In the past, it was for pretty much all of them, including Huawei Technology, the company that has been blacklisted by the United States. But what the latest rounds of rules show is that these foundries, TSMC, Samsung, Intel also, are no longer going to be able to make chips for Chinese companies without restrictions. The U.S. government wants to change the parameters so that they need a license first before they make certain kinds of advanced chips for these companies. And the reason for that is because some of the chips that TSMC made in the past were made for a different company within China and then ended up with Huawei, even though it's blacklisted and it's not supposed to be able to get its hands on those kinds of chips.
Rosa, again, also a lot going on, of course, with some of the confirmations on the Republican side. I don't know how much of a surprise it was yesterday to see the Republicans rally behind the Pentagon pick.
Well, in a way, it's unsurprising because none of them seem to be willing before the hearings to say publicly anything of great concern. Any of that disquiet that we saw in the initial stages of Hegseth's name surfacing for the Pentagon chief dissipated pretty quickly. And even though we expected the Democrats to go hard for him in that hearing, and again, they did exactly that. All the main allegations against him, all the allegations of sexual misconduct, of public intoxication, the things he denies are already out there in the ether. The real fundamental question is he qualified to run the Pentagon, and what would he do as Pentagon chief? What are his views around, for example, women in combat and so on, or just deploying the U.S. military overseas? It's an enormous edifice, obviously, in a bunch of areas overseas, of high tension and proximity to war. So in a way, were they concerned about that? You didn't see a lot of questions from Republicans about that. And again, more broadly, it shows that Republican senators, by and large, seem to be falling in line with Donald Trump even before he's inaugurated, not wanting to be the ones who publicly challenge his thinking.
And Peter, I mean, Elon Musk is in court with the SEC, this time over Twitter. What do we know?
Yeah, Elon Musk has had quite a few clashes with the Biden administration. He's also had a lot of clashes with the SEC, the securities regulator in the U.S. The latest issue has to do with Musk's buyout of Twitter. It all goes back to March of 2022. He was buying shares in Twitter without disclosing it publicly. Apparently, he'd gotten up to 9%. You're supposed to disclose at 5%, and you're supposed to disclose within 10 days. It actually took him 11 days to disclose that he'd gotten to this level of 11%. The SEC alleges that cheated shareholders out of money. If they had known Elon Musk was actually buying up these shares, they maybe wouldn't have sold, or they would have asked for a higher price. So the SEC wants a penalty from Musk. His lawyer has been very, very critical of their requests. He said these are minor violations. The SEC is asking for about $200 million. He thinks they should pay about $100,000. But it's very likely this lawsuit is going to go anyplace because the Trump administration is taking over in just a few days.
Yeah, there's going to be a lot of changes in the next few days, and Donald Trump is floating this idea of creating an external revenue service to basically collect tariffs on foreign imports. Is it controversial?
Well, it's interesting. Is it a name? Is it branding? Is it what exactly is it? He just floated this idea of an ERS overnight. I mean, there's already a government institution that collects these duties, Customs and Border Protection, and they are customs duties. So the duties are actually paid by U.S. consumers. This is not an external fee. I mean, it's kind of the price that consumers are paying for these things, and it's a small amount of revenue overall. It's about 2% or something. And so the question is this about just rebranding the existing machinery of government? Is he planning something else from it? It's very, very unclear. But what it does show, again, he's pointed in his thinking very much towards the idea of tariffs on other countries, and possibly much broader than we've seen before. It's really something he's not going to let go of, even if he goes more gradually on tariffs than he indicated initially. But again, at this stage, it's just a branding thing.
Okay, thank you so much for the briefing. I mean, you never know if it's the branding or something else. Ross Matheson and Peter Elstrom, we really get the A-team to cover our top stories. Now, for more on markets, we're joined by Michael Strawbeck, Chief Investment Officer at Lombard Odier. Michael, thank you for joining us. Again, there's quite a lot to wade through in terms of tech, in terms of these fights with the Justice inauguration on Monday. But I guess your number one problem or concern is inflation. Where does it go from here in the U.S.?
Good morning, Francine, here from Geneva. The buzz and the focus of markets has obviously been the pretty sharp rise in long yields in the US in the last 3.5 months or so. And we'll see some numbers in terms of CPI today as to is it really an inflation problem or is it a reflection of a normalization of what we call the term premium, which is essentially that you get compensated for taking longer term risk from bonds. And our view is it's probably a reflection of better growth and also a bit of sovereign risk premium because of the debates about the US deficit.
So, Michael, I mean, and you're right. Last week, I mean, there were questions, there were debates. It, ended up also infecting, or the UK ended up being, part of the epicenter for this bond rout. Are you expecting a lot of volatility? How do you view risk in the next couple of months as we try and figure out policies and tariffs from Donald Trump?
Certainly. I mean, we're in a phase of volatility and normalization. I mean, post-COVID, we've seen, of course, as we know, inflation roaring back, and the Fed, of course, starting to dramatically raise short-term interest rates. We had, at certain points, of course, a quite deeply inverted yield curve. All of this is normalizing, but the situations are between the US and the UK, of course, are quite different. In the US economy is strong, inflation is normalizing. There's a question about what is the Trump administration going to do in terms of tax policies and so on, and is the debt there a problem? Our view is very clearly it's not. The UK, on the other hand, has about half growth of the US. As I've said, and as we've discussed you and I before, the UK needs to come to a situation where it is on fiscal sustainability. Bond vigilantes in the UK are much stronger than they are in the US, and I am not quite certain as to whether politicians in the UK have understood the seriousness of this, and we'll see how that plays out in the coming months. Our view is very clearly that bonds in the US, because of these levels, are becoming more attractive. We've been underweight treasuries in the US, but we've been overweight, actually, UK gilts and German bonds, because we believe the European story is really much more about softening of growth and therefore coming down of long-term yields.
Michael, overall, what's the biggest unknown out there, apart from I guess geopolitics and tariffs? And is there a concern that this could weigh on earnings per share for companies? And so U.S. equities have already priced in the best news.
I would still say the proof is in the pudding on inflation. I mean, we're quite sort of confident that we can land the disinflationary trend. But of course, with Trump coming in, the fact is that we will sit at higher levels in the US. We will diverge dramatically in other regions because we have a different growth outlook and also inflation there coming down. Our view is, as the ECB is far behind the curve. They need to do much more. And for markets in general, this is a tightrope of high equity inflations as yields are going up. So we'll probably have to just wait a few more months. Maybe we get even a dip in equities because people get really nervous about these yield levels, but that probably could be a dip to buy. But I think the first half, of course, the biggest uncertainty is what is Trump really gonna do that he is saying. Tariff is short-term clearly a negative on markets, so therefore we could see a further trigger of uncertainty and corrections because of that. But midterm, if he starts implementing some of his policies that he has publicized, U.S. growth could look good, and therefore we could start the climb again in equities, if you will.
I mean, there's also quite a lot of going on, of course, in currencies. Most analysts expecting a stronger dollar because of the policies, but we also know that Donald Trump probably wants a weaker dollar. So what are your top 3 risk-on bets for 2025, given all of the uncertainties, Michael?
Well, the top number one, as you just alluded to, really is a stronger US dollar because of rates differentials and because of now yield differentials. That will draw a lot of capital to the US because it's simply, from a total return perspective, more interesting. So the dollar is one of our top views. Number 2, we're overweight right now US equities. We do believe that we are in a cyclical bull market that for sure is a bit sort of longer dated because we've now seen 2 years of total returns of north of 40%, but they can, in our view, continue to grow on the back of strong earnings, Trump policies, and if I were to pick one again, look for Japan. Look for corporate governance, positive earnings dynamics, etc. in Japan in the face of a yen that look relatively weakish, and that's good for the Japanese equity market. So go for those directions. We like gold still in this geopolitical political environment. So those are sort of our top likes, if you will.
Michael, thank you so much, as always, for joining us. Michael Strobeck, their Chief Investment Officer at Lombard Odier. Now, coming up, new risks to oil supply. We'll discuss the latest with the IEA's Toral Bozzoni. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Now, the International Energy Agency says global oil markets face a smaller surplus this year than previously expected. This comes amid stronger demand and new risks to supply. I'm joined exclusively by Toral Bozzoni, the head of oil markets division at the IEA. Thank you so much, Toral, for giving us a little bit of your busy schedule, as always. Now, despite the U.S. sanctions, and we had fresh ones actually announced last week, you haven't changed, you're still seeing actually Russian production rising this year. So is it that you're seeing the sanctions as not that big a deal?
No, not at all. We expect these sanctions to have, they're intended to and expected to have quite a significant impact on Russian oil supply and global markets, but we think it's still too early to determine what that impact will be. So we're waiting to see how things will unfold before putting a number on it. But just to put it in context, as you said, we were expecting to see a relatively balanced market in 2025 as growth from other non-OPEC producers exceeds our expected demand growth. So there is some room to accommodate losses, not just from Russia, but also potentially from Iran.
So can you give us a rough estimate on how much you think Russian output will be?
So the question is, because the latest sanctions, of course, two of the major oil companies were sanctioned. They were producing about 1 million barrels a day between them. But importantly, a lot of tankers, 160 tankers carrying Russian, Iranian oil, were put on the sanctions list. And these tankers in 2024 transported about 1.5 million barrels a day of mostly Russian crude. So there's a wind-down window of about 60 days where they can still discharge, but they cannot load any more oil. So the question is if non-sanctioned, non-gray fleet tankers will pick up the slack, because they could so if the oil is priced below the price cap of $60 for crude. So this is what we have to see, how other actors may step into the market to move that oil and what the buyers will do. The major buyers, obviously China and India and some other countries in the Middle East, how they will react to these sanctions is what we're waiting to see.
Toril, your report also shows a narrower oil surplus actually for 2025 than previously thought. Does that mean that there's any room for OPEC Plus to proceed with plans to restore supply?
Yes, so we have increased our demand growth slightly for the fourth quarter and 2024. Cold weather in the Northern Hemisphere was a large part of that as we returned to colder weather after two winters. Last winter in 2023, it was relatively mild. So we're seeing oil demand boosted in the US and Europe, but also in Asia due to colder weather. But we are still expecting supply growth from non-OPEC countries of about 1.5 million barrels a day in 2025, which is more than the 1 million barrels a day of demand growth that we expect for this year. Of course, with Russian supply and Iranian supply at risk of disruption, there will maybe room for OPEC to unwind cuts as they have signaled for some times that they plan to do in 2025. OPEC Plus today, we see them sitting on about almost 6 million barrels a day of spare capacity. So they have the opportunity to do that if the market conditions should warrant.
And Toril, will you see the Trump administration's policies actually significantly increase oil production?
It's hard to say. We think in the short term, policy decisions tend to have a minor impact on oil supply, of course, but the U.S. is already expected to be the largest source of oil supply growth in 2025. Although the growth has declined or eased from recent year, we're expecting about 600,000 barrels a day of increases in oil supply in the United States in 2025. That's marginally lower than the 700 that we saw last year and more than 1 million in 2023. So U.S. is already expected to be the largest source of growth. And as for the new policies, we will wait to see what those are and how they will be implemented to assess the impact on our forecast going forward.
Toril, thank you so much. Toril Bozzoni, there, head of the Oil Markets Division at the IEA, of course, on this new report out today. Much more to come. This is Bloomberg.
multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Oil price cap. I have been advocating for this when I was Prime Minister of Estonia, and I'm really pushing for this to be lowered because it has a clear effect. What we see on Russia's side, I mean, they are struggling because their national fund is depleted and they don't get the same revenues that they did from oil and gas. But there's still room that we can use, and definitely the countries need to discuss that.
Well, that was the EU's Foreign Affairs Chief, Kaja Kallas, on seeking to lower the price cap on Russian oil to deprive Moscow of revenue. And the UK City Minister, Tulip Siddiq, has resigned from government. It follows an ethics review into allegations she benefited from properties that may have been acquired with funds embezzled with the ousted Bangladeshi regime of Sheikh Hasina, who is Siddiq's aunt. Now, Tulip Siddiq says she has acted with full transparency. She's been replaced in her ministerial role by Emma Reynolds, who was formerly chief lobbyist for the industry group, the City UK. Well, coming up, South Korea's president is arrested over martial law fiasco, the first incumbent to be taken into custody in the nation's history. This is Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's sometimes you look at it and you marvel and you think about, how was this created? And was I the person that was behind getting this thing done?
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. UK inflation cools unexpectedly for the first time in 3 months as traders add to BOE rate cut bets, while markets now await US CPI data for clues on the Fed's path ahead. Now, the US plans to unveil new rules to curb the flow of chips to China as part of a flurry of measures introduced in the final days of the Biden administration. And Elon Musk is sued by the SEC, which claims he cheated Twitter shareholders out of millions by waiting too long to disclose his growing stake in the company. Now, Yoon Suk-yeol has become the first sitting South Korean president to be arrested. That's after investigators launched a dramatic pre-dawn raid on his residence following his short-lived martial law declaration. Now, let's get more with Bloomberg's Jill Deeses. Jill, thank you for joining us. So how did the arrest actually unfold?
Well, Francine, obviously there's been quite a bit of buildup to here. This is all, of course, in response to his decision, President Yoon's decision last month to declare martial law. Investigators from the Corruption Investigation Office had been trying to bring him in for questioning. He had defied those orders, and this all kind of culminated, just the other week in a really dramatic attempt to sort of pull him in and arrest him. Of course, they were met, though, those corruption officials were met with resistance from quite a few from Yoon's own security detail. So this was their second attempt to do so. He ultimately decided to just go along with them. He said that he wanted to avoid unnecessary bloodshed. There were several concerns that this would have resulted in a very violent confrontation, but at this point, he's gone along working with those investigators there. He's been brought to detention, and then within the next 48 hours, maybe a bit less there, those corruption officials are going to have to decide whether they want to sort of extend an order to keep him detained for a bit longer as they sort of sort through this, as you mentioned, this very unprecedented arrest of a South Korean president.
Are there concerns for instability in South Korea, which of course is a U.S. ally, a key U.S. ally, just as Trump is about to take office?
Yes, I think that's a good question, Francine. I mean, I should point out that this sort of arrest is very separate from an ongoing impeachment proceeding that's actually taking place, with Yoon. He's already been stripped of his powers. There's an impeachment hearing that's kind of, that could take weeks or months to ultimately resolve, trying to decide whether that's permanent. That's going obviously concurrent with whatever results from this arrest. And this is a really, South Korea is a very key ally for the United States. There's a lot of, sort of concern over how exactly this relationship unfolds when Trump has made it clear that he's open to, putting tariffs not just on U.S. adversaries, but also on U.S. allies. There's a lot of concerns over Trump's relationship with North Korea, for example, that obviously entered his relationship with Kim Jong-un, entered the international conversation back during his first term in office. So I think these are questions when you do have this power vacuum within South Korea, questions about who will ultimately be leading the country, how exactly, this process against, this President Yoon is going to resolve, and where things will go from here does leave a lot open when we're just days away from the inauguration of the incoming U.S. president.
Jill, thank you so much, as ever, for a terrific briefing. Jill Deesis there from the very latest on South Korea. Now to France now, where the French Prime Minister, François Bayrou, has offered to renegotiate a contested 2023 pension law. Now the pension reform concessions come as Bayrou seeks the backing of lawmakers to stay in power and urgently adopt a budget.
La loi de 2023 a prévu.
The 2023 pension reform law is expected to first push the legal age of retirement to 63 by the end of 2026. Therefore, a window of opportunity has opened. I would like to set a shorter-term deadline by the fall when the next Social Security financing law will be discussed. We can seek a new path of reform without any totem and without any taboo.
Now, Southern California residents exhausted by a week of wildfires, evacuations, and blackouts are facing another night of critical fire danger. Returning Santa Ana winds are threatening to fan the flames, with more than 10 million people facing what officials call a particularly dangerous situation. Estimates of the insurance bill keep rising, with Keefe, Bruyette, and Woods also now seeing losses as high as $40 billion, double their previous estimates. And Meta is to cut roughly 5% of its staff through performance-based terminations, affecting about 3,600 people worldwide. In an internal note seen by Bloomberg, the chief executive, Mark Zuckerberg, says he has decided to raise a bar on performance management. Now, the Instagram owner plans to hire new people to fill their roles later this year. And the UK government has unveiled a new plan to harness artificial intelligence for public services, expanding supercomputing projects, and attract technical talent to the UK. Critics say Keir Starmer's Labour Party has been slow to introduce such policies, and Britain has no formal laws to regulate AI. Now, that's in contrast with the EU, which approved the world's most extensive rules last year. My next guest is a leading authority on regulation in the sector. Ivana Bartoletti is Global Chief Privacy and AI Governance Officer at Wipro, one of India's biggest software services firms. She's also founder of the think tank Women Leading AI. So, Ivana, thank you so much for joining us. There are many questions about where AI goes from here. What's the right approach for companies and especially countries? Is there a worry that if you regulate before you understand the power it does, you get left behind?
I mean, I think the main issue is not regulation. The main issue is bad regulation. And I think to an extent, AI has always been regulated because it's not new. And also because it doesn't exist in isolation. So legislation like privacy or data protection, security, or human rights, consumer legislation, they've always applied. I mean, if you look at the US and the role the FTC has been playing over the years in protecting consumers from the harms of AI, has been quite substantial. Europe has taken an approach, which is the European AI Act, which is risk-based and to an extent considers an AI product as any other product. So, but with a twist in the sense that harms to fundamental rights of individuals also need to be taken into consideration. The UK has unveiled a plan, which I think is a good plan, which is very broad and ranges from data centers to skills. Of course, the detail will be in the implementation, but I think the UK is, to an extent, doing what many countries are doing right now, which is to say, how are we going with AI? And how are we ensure that we harness innovation, but at the same time, we safeguard and protect people's rights? So, for example, because there is a lot of emphasis on AI use in public services and the NHS, for example, the government is quite clear that technologies like privacy-enabling technologies they need to be at the heart of how data is shared for example, AI use in health.
So, Ivana, how, for example, is Wipro balancing this compliance? Because, again, it's the desire of clients to move rapidly on AI implementation while safeguarding everything.
To me, the key point is to move beyond the hype. See, that's the thing. Because it's all good to talk about AI skills, but one key point for me is to say, how can organizations take the most of artificial intelligence, starting from the question of, what is the problem that I'm trying to solve? AI can enhance productivity, can make things more efficient. Employees can be very relevant because they know products, they know their products, so they can really play a key role in understanding how to work with artificial intelligence. And then obviously what is really important is the sound governance framework that enables the whole organization to come together to understand how AI changes the workplace and what is the impact on from a technological standpoint, but also in terms of the wider organization and employees as well.
So is your go-to-market approach with respect to AI different in the EU versus other regions like the US, for example, because of the regulatory change?
Well, you're actually touching something very important, which I think is for businesses is crucial, which is the fact that, of course, divergence across different countries matters, because what happens is that if countries have different requirements, then obviously when you work with clients operating in different jurisdictions, you have to make sure that you code and you hard code into what you produce and work with clients on legal protection, security and data protection and privacy, which of course can be different across jurisdictions. But I also think it's important to understand that there are things that are the same all around the world. Privacy, for example, coding privacy into AI is something that is not just European. You know, privacy matters in the US, in India, in the United Kingdom. So there are some elements: transparency, privacy, cybersecurity, robustness, human oversight, which cut across jurisdictions. Of course, there are differences, and this is why it's really important on the governance side that the UK continues to lead on how we globally want to govern artificial intelligence. This is important for the world, it is important for business as well.
Ivana, you also have at Wipro, of course, a lot of financial services as clients. How are they thinking about AI and how they're implementing it?
Yeah, it's really interesting because AI in financial services is, first of all, financial services an area which is regulated. And in fact, if you think, for example, the role that the FCA, together with the Information Commission, that have been playing in the UK, is certainly not new. The role of, for example, what is the implication of artificial intelligence used as algorithmic decision making decisions around people's and their in financial services. That is something that has been in the heart of the discussions for a very long time now. So I think financial services are the ones that are heavily regulated, but it's also ones where artificial intelligence can really bring a lot of productivity gain and efficiency. And this is it's both in relation to managing clients, but it's also in relation to investment and wealth management more in general. I think this is where we are putting a lot of effort in ensuring that legal protection and regulations are coded and embedded into all the products that we work on in this space.
Ivana, thank you so much. Ivana Bartoletti, there, Global Chief Privacy and AI Governance Officer at Wipro. Now, coming up, VW braces for another tricky year with no new electric car models. We'll bring you the latest on that story next, and this is Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve. And This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Well, the EU's climate commissioner says tougher targets would give predictability to the auto industry rather than being a hindrance. Now, he spoke exclusively with Bloomberg's Oliver Crook in Brussels.
This is a tremendously important industry for Europe at large. I think it employs roughly 13 million people in Europe. It is hugely important for our overall GDP, and we will make we will go to great length. We'll do our utmost to secure that this sector has a very bright future here in Europe, full stop. Having said that, many in the car industry actually tell us at the same time that we need predictability, that we need to stick to the 2035 goal, and that we can be much more effective in helping them out in making sure we protect the level playing field, in making sure that the loading infrastructure that people need to drive from A to B is actually there. And frankly speaking, I think Europe should do a better job, and member states should do a better job in investing, that they need way more investments in the grid. So I think that package in the end is far more effective. Now, you're going to tell me that I didn't answer your question, and you want to know about the the fines. I cannot yet say how that eventually will play out. But what I can say is that we had roughly the same situation, I think, in 2020, when just before the deadline, there were huge worries about how these fines would play out. In the end, only one company was fined, and it was only a fraction of what was anticipated.
So then what can we expect in terms of these fines? Well, how much money do you think we're looking at for these car makers?
What I think is here again, we should not look at this one-dimensionally. What we need to do is we need to make sure we have a dialogue with all the main stakeholders in this, again, tremendously important sector that we will never, ever let down. And that is precisely what Ursula von der Leyen is embarking on. Have a dialogue on all the necessities, also all the requirements, because make no mistake, various players in the sector have different demands. Some might like to change part of the regulation we have. Others are ferociously lobbying us to keep things exactly as they say, because they are saying, well, we already made the investments. So I think what we need to do is take the full picture, have that conversation with them in the weeks to come, and then come up with a long-term and short-term solution that is good for Europe and that is good for them.
Well, that's the EU's chief climate, of course, speaker, talking to Oliver Crook in Brussels. Now, after a tough 2024, Europe's biggest automaker, Volkswagen, is facing another trick here. Deliveries are at risk of slumping again, with its namesake VW brand having no new electric car models this year. Well, Bloomberg's global automotive editor, Craig Trudell, has the very latest. Craig, first of all, I know everyone's keeping you busy, including Elon Musk, but what stands out to you most when looking at the VW sales?
Yeah, I mean, I guess the biggie for me is looking at China. The performance in the fourth quarter of last year was not particularly strong. It was kind of a continuation of the theme that we saw throughout 2024. I was a little bit surprised that the company came out and sort of, put a stake in the ground to say, we're going to get back to 4 million units in this market. I don't know how exactly you get there if you're VW. And this is a company that, I think there was a general sort of assumption that we would see this sort of steady march, right, of ever higher electric vehicle sales. For them to have a setback in 2024, I think is really troubling given where the policy is going, as we just heard from the audio that led into this.
So what's 2025 like? A gap year? I mean, do they just say, like, look, this is going to be a reflective year, or is this the time where we have to push against even U.S. policies when it comes to EVs?
I think there's some question of how much did VW try and sort of strategically put off what deliveries it could from 2024 for 2025. To the extent they had customers who put in orders and they sort of slow-walked actually delivering those vehicles so that they could count toward 2025. Because I think, sort of universally the expectation is they're going to need to get some help, some outside help, in order to comply with these tougher rules coming into force this year. And there are some real questions about, where that help is going to come from and whether it makes sense, from a policy perspective in Brussels to really have, a company like Volkswagen potentially have to pay the likes of Tesla or, say, BYD to help comply with rules in this region. I think you'll find some folks in and around the EU who will say that doesn't make a whole lot of sense.
So again, what's the strategy to get back on track? Is it new models? Is it just complying? Is there anything? Do they need to team up with someone who does, desirable cars?
Yeah, I think this is a company that does have cooperation with XPeng, a Chinese company that is held in pretty high regard, and in high regard for some of the elements of electric vehicles that VW has real weaknesses. I would point to software being the main one. There's a similar sort of cooperation happening in the U.S., of course, with Rivian, but that's not going to help them much at all here in Europe, right? This is really a sort of North American-focused cooperation. So, here in Europe, this is still a company that is in a dominant position. We should give them credit for still being far and away the number one in this market. And yet there are some real questions about, just how sort of tenable that position is, given where the industry needs to go and the challenges they're having getting there from an electric vehicle perspective.
Okay, thank you so much, Craig Trudell. They're our global automotive editor. And then I need to ask you about the Cybertruck, because I saw the first one actually in South America, and we followed it because I was so intrigued seeing one on the road.
It's not easy on the eyes.
I mean, it's quite robust, I would say, Craig. Thank you, as always. Now, one of the top red stories on the terminal at the moment, Germany's economy shrank for a second consecutive year in 2024 and is unlikely to grow much in 2025. Now, it's only the second time since 1950 that output has contracted for 2 years in a row, and lays bare the challenge for the country's new government once snap elections are held next month. Coming up, Wall Street earnings season kicks off today with Wells Fargo, Citigroup, and JP Morgan all due to report. We'll bring you a preview next, and this is Bloomberg.
Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
historically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back, everyone. Now, Bloomberg has learned that Jen Piepszak has been named JP Morgan's new chief operating officer, but she's ruled herself out as a possible successor to chief executive Jamie Dimon. And now BlackRock is also seeing its succession outlook shift as senior executive Mark Wiedman is choosing to pursue opportunities outside the company. Well, joining us now for more on this, and of course to look ahead at the start of Wall Street earnings later today, is Bloomberg's Jenny Serrain. Jenny, thank you so much for joining us. I mean, what's going on in the water? Like, I feel like, you know, some of these two big financial companies, suddenly everything's in the shift with succession talks.
No, I think you're exactly right. I think it's an interesting time, and I think a lot of this just boils down to the fact that you have two chief executives, Jamie Dimon and Larry Fink, that have been in their post for a very long time. They're really considered almost statesmen of finance, and so it's hard to imagine life without them on Wall Street, but obviously that's what these boards have to do, and so this is multi-year processes where they obviously look at lots of different candidates and put these guys and gals through the ringer. But I think, yeah, it's interesting that it's all coming to head kind of at once, but it'll be interesting to see if we actually kind of see either of these two, titans of industry move on anytime soon.
I mean, Jen Piepszak for me was interesting because did she rule herself out of becoming CEO, or does she just not want the attention in the next couple of years?
I think it's time will tell. So what we reported yesterday was that JP Morgan, a spokesman for them, said she's not interested in the role at this time. And so it's a super interesting time then for JP Morgan, because I do think she was obviously considered one of the real front runners for this. And so now the spotlight sort of shifts back to some of the other top executives that they have in the wings. But I think she was one of the ones that was being kind of groomed and expected to possibly take place. And so it's definitely kind of put the pendulum back in swing, as it were.
Jenny, in 20 seconds, what are we expecting from earnings? Is it all Trump policies?
I think Trump policies and yeah, I mean, rates. So if rates aren't coming down as quickly as everyone once thought they were, does that mean that these guys have a little bit more room to run on the revenue side? That's certainly a welcome news, in addition to Trump coming in place next week and bringing all of the deregulation that he's supposed to bring.
Oh, those earning calls. I can't wait for all those earning calls to try and figure out what they're thinking. Jenny, thank you so much. Jenny Serrain, there, who leads our finance team in the UK. Up next, Bloomberg Brief, Manus Cranny in New York. This is Bloomberg.
what about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set that agenda. Bracing for CPI, risk markets seek guidance on the evidence to bolster an extended pause. Washington seeks to tighten its grip on the chip flows to China with fresh regulations aimed at producers around the world. And big bank earnings kick off. JP Morgan, Goldman Sachs, Wells Fargo, and Citi all on deck. Let's just check in on those markets. It's going to be a bumper day for those bank earnings, as we say to you. But your risk is this, CPI. The consensus is around plus 0.3%, but the market is expecting a 1% swing in these equity markets, probably the biggest day since March 2023. If it comes in as a hot print, you shred the rate cuts and you embolden the hard pause narrative. David Costin over at Goldman Sachs likes the mid-caps relative to the large caps. As you can see, mid-caps pacing ahead, up by 0.5%. It is ground zero to the burning in the bond market. Has it stopped is the question you need to ask yourself. We'll talk to Mitesh Parikh in just a moment on that. 4.76 is where we are. A note from RBC Blue Bay, Mark Dowding, a big bear on these bonds. He said, look, when the long end of that curve hit 5% for him, it was a signal of a top. But we'll talk about the provocation from the five-year inflation expectations. There are some stocks that we are keeping an eye on for you, and this is the roll call. TSMC, well, we're keeping an eye on that. This after the US plans to introduce new regulations to prevent advanced chips from being sold to China, targeting chip producers. Also watching Apple, as TSMC is a major supplier to the iPhone maker. As you can see, they're up 0.2%. Now, KB Home's great numbers yesterday, rising after Seaport Global Securities raised the recommendation on KB to neutral from sell after the company topped out on their estimates. And in just a few moments, as I say, we'll catch up with Mitesh Parikh of Schonfeld, and later in the hour, Keith Lerner of Truist will join me. My first guest of the day is Mitesh Parikh from Schonfeld. His outlook for the year is this. As we enter 2025, markets are navigating a unique combination of macro forces, a sharp repricing in interest rates, tightening financial conditions, and shifting geopolitical narratives. I'm pleased to say he joins me now. Mitesh, in terms of the daily news flow that we're getting, the momentum is building there. We're devouring policy balloons that go up, but we are recalibrating. We're forced to recalibrate because of the bonfire in the rates market. To what extent are you recalibrating the level of risk that you will take right now?
Yeah, hi man, it's nice to be back and good to see you again. Look, I think the first thing to say is that we have had a significant repricing of term premia across bond markets everywhere. It's been driven by the US, predominantly by the Fed, who kind of shifted to a more hawkish stance at the last FOMC meeting. And look, with that comes a lot of opportunity. As we've seen, the vol environment has increased quite significantly now that Trump has come in, and we expect that to continue. So I just think 2025 will be a very different market environment to 2024, where the sharp of being long equities was exceptionally good for the majority of the year. This year, I think it's going to be much more choppier. It's going to be more of a trader's market, and there's going to be a lot of opportunity to be able to lean into dislocations.
Let's just dig a little bit deeper into the bond repricing. You say a great deal of the move is attributable, 70% of it is to term premium. When I look at the 5-year forward break-evens, Mitesh, this is flagging still that this bond market has still further to dislocate. Would you agree with that, or do you think that we're topping out in terms of the run higher in yield?
Yeah, so look, I think what's interesting is that the shape of the curve, if you look at the OIS curve in the US, is actually exceptionally flat, especially between kind of the 2-year and kind of 7-8 year point. And really, we're in a data-dependent environment now, in the sense that labor markets have been exceptionally strong in the US. That continues to be the case. The 6-month run rate is still around about 165,000 jobs being created, but the unemployment rate's just a little bit higher than 4%, which is historically very tight. So look, we've got a big inflation print coming up. The market's kind of leaning into a 0.3 on core. No one's expecting a 0.4. I think that is, a hot number on that print would obviously be something that would cause further ruptures in the bond market and, a much more aggressive sell-off. The front end only has about 23, 24 base points of cuts priced left for this year. But again, no one's really expecting 0.4. That's obviously the risk, and I think that would, pressure equities as well further from here. And conversely, a softer number would see a little bit of relief. But to answer your question, I still continue to think that the US consumer is very durable, and, with Trump coming in, policies most likely to be on the inflationary side, bonds could still remain under pressure for now.
Well, this is the debate, isn't it, whether we're in a danger zone. Stephen Major sat in the very same seat that you were in 8 days ago. He said that he sees this bond route, the area we are, 4.7, maybe even to 5%, as an opportunity in a danger zone. How do you look at that, given what the Treasury Department told us last night, $2 trillion for the calendar year in terms of the fiscal deficit, 87 billion in December? There is a moment where this exorbitant privilege could be challenged, isn't there?
I don't know. I take the other side of that a little bit. I'd say if you look at the forecasts from the Congressional Budget Office, essentially we're running a debt to GDP ratio around about 100%. In 10 years' time, their forecast for 2034 is around 116%. For real debt sustainability questions to be raised, you're going to be running something like 250% of GDP in terms of a debt to GDP ratio. Japan is somewhere around that, but Japan has a lot of household savings, different demographics. The US is a very deep and liquid market. The dollar is obviously very prominent in financial markets, and the Fed have a lot of credibility. So yes, while I agree that we can see more term premia being priced into the back end, I'm not entirely convinced that we're in the realm of seeing bond markets and back ends completely run away because of deficits at the current time. And then look, in terms of pricing right now, I guess it really depends on where's a buy. Like at the front end of the market, I think 2-year yields are now yielding higher than where Fed funds is. I think that's relatively asymmetric. At this point in the cycle, if there was to be any sort of shock, then while the market can still price further moves higher in yields, I don't think there's a ton of room at the front end for that to happen. I certainly think the bar for a hike is very, very high, but at the back end, things can keep going. And, you can see the curve still meaningfully steepening from here. 2-10 swaps are, only just positive. So there's still potentially a lot of room to go, as investors demand more return for, owning duration in the US.
I think it's very fair to take the other side of the trade. I think the market, the bond market, most markets are worried about the fiscal discipline and largesse that is set to come. I like the phrase that you use on the dollar, and I'm curious to what you make, how you expound on this. You see it as a wrecking ball, but it's a wrecking ball of destruction for emerging markets. But what's the tail risk of this stronger dollar to the U.S.?
Yeah, so look, for multinationals and corporates, obviously it's probably, it is impactful to their balance sheet, as the dollar continues to strengthen. And if you look back over the last few months, we've seen a 9% increase in dollar strength. So, that does generally impact some of these multinational corporates that have meaningful exposure overseas as the dollar gets stronger. Look, I think with everything, some of these themes have become a little bit mature. We've seen meaningful moves, and certainly the market's pretty positioned long dollars as we go into this CPI print. And, we have seen a very significant reprice in duration and the front end of curves. Now, that doesn't mean it can't go further, but I think you've got to think about differentiating between different markets. Europe, China are fundamentally in very different places to the US. UK also, from a stagflationary perspective, in a very different place to the US as well. So I think we're going to see much more differentiation across markets as we head into 2025.
Okay, dexterity is the name of the game, and differentiation. Mitesh, thank you very much for setting the agenda this morning. That is Mitesh Parikh of Schonfeld. Other stories trending on your Bloomberg terminal this morning. This is what we got. Residents of Southern California are facing another night of critical fire danger due to returning Santa Ana winds and minimal humidity. The region has seen little rain, with a death toll of at least 24 and a massive destruction. New estimates of the total losses for the insurance industry are now seen as high as $40 billion. The DOJ Governor Ueda joined his deputy in signaling the potential for an interest rate hike next week, which led to a boost of the yen. He also indicated rising confidence over wage increases after hearing encouraging views at the BOJ's recent branch managers meeting. Overnight index swaps show a 68% chance of a rate hike later this month. South Korean President Yoon has been arrested by investigators after repeatedly defying summons to appear for questioning over his martial law declaration. The arrest makes him the first incumbent president in the country's history to be taken into custody. Yoon will be held for 48 hours before potentially being detained for 20 days. Coming up, tighter grip on the chip makers. Washington plans another round of regulatory push on producers. More on that story next.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Monday, Donald Trump will be sworn in as the 47th President of the United States. Bloomberg will have special coverage of the historic inauguration, live from Washington, D.C. It all starts at 11 a.m. Eastern.
It is Bloomberg Brief. I'm Manish Cranny in New York. Let's just check in. We've just finished a conversation with Mitesh Parikh there of Schoenfeld. This is about volatility. This is about being dexterous in the year ahead. And ground zero for that is the foreign exchange market. This is what we've got for you at the moment. We have seen serious moves on the CPI in the UK, a slowing in UK inflation, and that brings sterling back to 122 is where we are. Traders are now fully pricing 2 cuts for 2024. The dollar on the back foot, it's going to be a wrecking ball, according to Mitesh Parikh, in terms of its influence on the emerging markets. Also keep an eye on dollar yen for you. I mean, this is going to be a hot meeting in January 23rd and 24th. A hot meeting. Ueda joining his deputy on the risk of discussing a rate hike. So dollar yen is certainly worth keeping an eye on. Well, in the US, we've got new regulations to prevent, you got it, advanced chips from being sold to China, and calling for more diligence from the chip makers. That's after an incident last year where TSMC found that a client was delivering its chips to Chinese tech giant Huawei. Let's discuss what this new edict is about with our global tech editor, Peter Ahlstrom. Peter, it seems as if it's sort of like the last pull of the noose around China in these closing days of the Biden administration. What are they now targeting? What's the advice to the chip makers? And is the onus of responsibility on self-policing sort of in a new way?
Yeah, it's almost hard to keep track of how many regulations the U.S. government is coming out with in the last days of the Biden administration. We've had some of these new rules almost every day now. The latest round of restrictions from the Biden administration targets TSMC, Taiwan Semiconductor Manufacturing Company, really the most important producer of semiconductors in the world, along with Samsung and Intel. These are the companies that make chips for a bunch of other companies. TSMC makes them for Apple, for example, for the iPhone, and also for NVIDIA for their GPUs. But they also make a lot of chips for Chinese customers. They have in the past, and before U.S. government restrictions, they made them for Huawei and some other companies too. What they are now trying to do is tighten that ability to make chips for Chinese customers because, as you referenced, they found out that one of the chips TSMC had made, or one kind of chip that they had made, ended up in Huawei's AI servers. That's exactly the kind of shipment that the U.S. government is trying to stop as they try to hold back China's progress in AI in particular. And so they're trying to add some additional rules here. And now the presumption is going to be that these foundries, especially TSMC, cannot ship to Chinese customers without the approval of the U.S. government. In the past, the assumption has been they can unless the U.S. government blocks it. So it's an additional kind of restriction at this point. They're trying to tighten things up. But again, this is just days before the Trump administration takes over from the Biden administration, so it's not clear exactly how this is going to be implemented.
You know, listening to Gina Raimondo on her way out, this is about AI dominance in the United States of America and keeping it that way. That's the critical policy. Let's talk about the last roll of the dice for Gary Gensler. He's going after Elon Musk, the SEC. They're preparing to sue him. This is about how he built his stake, the timing of reporting and the building of his stake in Twitter, and what the impact that would have on the average shareholder. What is this lawsuit really about?
Right. So Elon Musk has had a number of clashes with the SEC over the past few years, especially under the Biden administration. The latest clash here is When Elon Musk was beginning to buy shares in Twitter before he did the full takeover of the company in March of 2022, he was accumulating a stake, and under U.S. regulations, once you get to 5%, you're supposed to disclose that publicly so people know maybe you're going to buy the whole company, maybe you're going to buy a bigger stake, and they can make informed decisions about whether they want to go along with an Elon Musk or whether they want to bet against him. But in this case, Elon Musk got to 9% again in March of 2022, and didn't disclose within the 10-day time frame that you're supposed to. He took 11 days. Now, Musk's lawyers are saying this is a very trivial matter, that the SEC is essentially harassing him over these kinds of issues. The SEC wants a penalty of about $200 million. Musk's lawyers say that that's ridiculous. It should be something closer to $100,000. So again, it's getting very contentious at this point. This, of course, comes on top of other clashes, like when Musk said he had the funding secured to buy out Tesla. That didn't happen. That led to another clash and some changes at Tesla because of that. But this is, as you say, this is Gary Gensler and Elon Musk going at it one last time before they change seats.
It's the last roll of the dice, Peter. Thank you so much, Peter Elstrom, there on the latest tech news. Coming up, Hegseth in the hot seat, 4.5 hours. More on the President-elect Trump's cabinet picks as they head to Capitol Hill today. Context Matters on Bloomberg. Good morning.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Manish Rennie here in New York. Your front pages from around the world is what we've got for you. First up, Wall Street Journal leads with the Gaza ceasefire deal is waiting on the Hamas side to give the final sign-off. Both Israel and Hamas have said all significant issues have been ironed out and that the agreement was at a final stage. Hamas then missed a deadline to respond to the agreement by several hours and has now gone silent. Next up, the New York Times leads with the former First Lady, Michelle Obama, will skip President-elect Trump's inauguration. The statement did not provide an explanation for why, but she also did not attend the former President Jimmy Carter's funeral. That was last week. Former President Obama is confirmed to attend. And on Bloomberg, Republicans rallied behind Pete Hegseth after his Senate confirmation hearing. He was hit by questions by Democrats over his qualifications and his character flaws.
Mr. Hegseth, I do not believe that you are qualified to meet the overwhelming demands of this job. We must acknowledge the concerning public reports against you.
Will you put your money where your mouth is and agree that when you leave this job, you will not work for the defense industry for 10 years?
Senator, it's not even a question I've thought about because it's not
think about it right now.
It's not one. My motivation for this job.
I understand
has never
that. I
been
just
about
need
what
a
could
yes or no
conceivably
here.
come next.
Time is short. I just need a yes or no.
I would consult with the president.
Joining us now is Ros Matheson. Ros, I watched a lot of this confirmation. I mean, Elizabeth Warren, apparently he's had a nomination conversion. I've heard of Damascene conversions. Now we've got a nomination conversion. Look, it was hard and heavy on his excessive drinking. He denied sexual assault. He said those were smear campaigns, his financial mismanagement of the not-for-profits. But the Republicans are galvanizing behind him. This is one showing and done. Your take?
Well, that's right. So you saw the chair of the Armed Services Committee, Roger Wicker, calling him unconventional, but saying all the same, you know what? You look at prior administrations, you don't really see that there's necessarily been a natural fit candidate either. I mean, we are talking about a very big part of the US government, both domestically and overseas. It was interesting in all the to and fro in the confirmation hearing yesterday, as you say, a lot of focus on allegations that have been widely discussed for quite some time about Hegseth and, you know, excessive drinking, those allegations, but less about, you know, what if you're going to run this thing, how are you going to spin it? What are your views on some of these key points of tension around the world? What are your views about, you know, the structural future of the military? When you think about where you need to take spending for a military that's going to be fit for purpose in 5, 10, 15 years, what are you going to be doing about that? And there was very little meat on the bones in that hearing about what he would do if he was in the chair. And I think that's what people really wanted to hear about. It's like, okay, you're likely to be confirmed. We can see that now. But what are you going to do once you're in the job?
And I think this is where it comes down to, and a lot of those allegations, just to reaffirm, were pushed back by Hegseth. They were allegations, they were smear campaigns on his drinking and on other impropriety. When it comes to the background checks, and this is where the hearing really pushed hard, is that only Jack Reed and Senator Wicker will have access to that FBI report. Again, it's a question of whether this individual has the capacity, and this is where the Democrats really push back. Do you have the skills, the financial management, and the ability and depth and breadth of knowledge to manage the U.S. Defense Department?
Well, that's right. Again, that is the key question, because the US is obviously trying to avoid being pulled directly into conflicts overseas, but an enormous amount of military support has gone on for Ukraine, sending an enormous amount of US military equipment, long range, short range, you know, artillery, and then thinking about, you know, how the Pentagon needs to work with the defense industry in the US, looking forward, these very big defense contractors that are quite lumbering in some ways. They want to operate on long-term contracts. How do you get them baked into the psyche of where modern warfare is going? How do you get them to change production focus potentially? All of that's really delicate, and it needs that very long-range thinking about where the military needs to be.
And that's in part what Hegseth pushed back on, and he did say this was about advancing the technological capability of the military. Ross, we'll see you again. Thank you very much for summing that up today. Of course, you've got Kristi Neum, Marco Rubio, and Chris Wright all up on Capitol Hill. We'll talk more markets ahead of the CPI with Truist in just a moment.
of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Manish Kranny. Let's set your agenda. Bracing for CPI, risk markets seek guidance on evidence to bolster an extended pause from the Fed. Washington seeks to tighten its grip on chip flows to China with fresh regulations aimed at producers around the world. And it is a big bank earnings day. We kick off with JP Morgan, Goldman Sachs, Wells Fargo, and Citi, all on deck. And that bumper day for banks will help define risk. We're a little bit bid this morning. You've got NASDAQ futures up just under 21,000. Prepare for one of the biggest swings in these markets since March 2023. We're looking for a 1% swing around the CPI. Could it be hot? Not the conversation we just had with Schoenfeld. They think it'll come in at plus 0.3%. But you've got to be dexterous in this market. There might be some value. Let's roll it over and have a look at the bond market. The short end is where there's perhaps a little bit of mispricing. That's according to Mitesh Parikh. You maybe want to see a little bit more of the rate cutting cycle return in the back end of the year. 10s trade at 476. These bond markets are looking at the inflation expectations, which are rising and have been above the level that we saw at 2.5%. Bond yields dipped by 2 basis points at the moment. My guest this morning is Keith Lerner of Truist, the co-CIO over there. Keith, looking at the bond market, I mean, 10s and 30s, the longer end of the curve is where you've had the dislocation, the highest level since 2023. The issue is this. You say that we need stability in the rates market to embolden the equity call. Do you think we're anywhere nearer the end of the tail wagging in the bond market? Let's start with what you need to set the risk table.
Yeah, well, great to be with you. I think you really framed that well. Well, if we go back to December 6th, when the S&P 500 peaked, what happened that day was that's when yields troughed. And since that period, we've been in an internal correction for this market as those yields have moved forward. So we do think, around this level, you're starting to see a little bit of stabilization. Obviously, that CPI report is going to be really important. But we do think we're getting closer to some type of stabilization. One thing that we're looking at that leads us to that conclusion is the U.S. advantage in yields relative to our G7 peers is the highest since 2019. And then we're also still seeing pretty strong demand from Europe and Japan. Again, it's all about the CPI report today, but we do think we're getting closer. And then yesterday in the market, you started to see things like mid caps, small caps, and utilities work. So the market's at least starting to lean that way.
And this emboldens the overall narrative about the flow of money into dollar, the flow of money into dollar assets. And that adds to the equity market story. We had Goldman Sachs on yesterday, and they said, look, you want to look at the broader market. I've got everybody talking about the broader market in terms of earnings and opportunity and discount to large caps. At what juncture do you want to be longer of the broad market, the Russell, relative to, let's say, the actual S&P, or for that matter, to Mag 7?
So the way we're playing this is we were positive tech all last year. We still think tech is the dominant theme of this bull market. However, late last year, what we did is we upgraded mid caps. And the reason for that is we do think there's going to be this seesaw, a tug of war between the macro environment where you'll see money shifting back and forth. It's going to be hard to time. Mid caps are cheap. They have better earning trends than small caps. They're also primed for that pickup in M&A that we expect, and they should also do good with deregulation and a resilient economy. So I think it's not just all or none. I think it's a combination of the two. As kind of just, again, dealing with this tug of war that's likely to continue this year.
Well, you also say that there's a tug of war between tech and banks. We're laying up for a big, big day in banks. Goldman's, JP Morgan, Wells Fargo, and Citi. So we're going to know a lot more about whether it was good volatility or bad volatility in the last quarter. But I think the assumption is good volatility, splendid investment banking, and we'll find out more about NIMs. How do you look at tech and bank? Banks have had a great run. And cast forward, we're looking for deregulation and a healthy story. Where do they fit in the narrative for you?
Yeah, it's similar to that kind of that large cap and mid cap. And when you think about tech, that's the largest component of the growth indices, and financials typically are the biggest sector in the value indices. I mean, so we're at this point we're overweight tech and we're overweight financials, so we're overweight both because of that seesaw. And I think in general on the financials that we talked about a little bit earlier is that we're still positive on the banks. One, we have a resilient economy, deregulation. We also have a positive sloping yield curve as well. Credit remains pretty firm as well. So you put all that together, I think this is still a good environment, and the technical trends are still favorable for financials as well. So we like them. Obviously, it's hard to say what's going to happen today, ahead of the earnings report. But as we look for this year, we're still positive on the group as a whole.
It's interesting when you open your app, sometimes my own personal app, you see the mark to market, and even a small move has an outsize impact on the overall portfolio. You said pullbacks are always uncomfortable, and these aren't even pullbacks, Keith. These are just moments in time of where we're retracing. Pullbacks are always uncomfortable, but they are the admission price to the market. So what provokes a scalable pullback?
Well, I think it goes back to the 10-year, right? So going to the first statement, we've had 30 pullbacks of at least 5% since March of 2009, right after that, where the bull market lifted off after the financial crisis. Despite that, this is a crazy stat, we're up more than 1,000% for the S&P, including dividends. So that's why we say this is the admission price of these pullbacks. But to your point, what causes something more sinister, again, not a base case, is that the overshooting yields goes much higher than even 5%. And it's the pace at which it goes and things become unhinged. That's not our base case. That's the risk. The good thing right now is even though as yields have moved forward or up, credit spreads have remained very benign. So we're not seeing something systemic at this point, but that's the risk.
Yep, if those rates do blow out hard and heavy above the 5%, it could be the dislocator that everybody's perhaps thinking is hiding in the tails. Keith, thank you very much. Keith Lerner there of Truist on the markets. Coming up, Elon Musk is in the SEC's crosshairs. The agency is suing the billionaire over his Twitter buyout. More on the story in just a moment.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
It is Bloomberg Brief. I'm Manish Cranny here in New York. Washington plans to roll out additional regulations to prevent chip sales to China, this time aiming at firms including TSMC, Samsung, and Intel. Let's get to Tom McKenzie tracking the chip and tech stories. Tom, again, this is the last pull on the noose around access to chips for China. But this is, what exactly is this regulation going after? Because we got the traffic light system on Monday about high-end chips. So what is this about? Self-policing? You keep an eye on where your supply chain is going to, where your chips are going to in the supply chain?
I mean, it's partly that, Manus, certainly, and it is, to your point, building on that traffic light system, the tiers 1 to 3 that were outlined on Monday by the Biden administration, with allies in tier 1, those who are considered, of course, enemies to some extent, China, Russia, certainly adversaries, on tier 3, and then in the middle, the rest of the world. It's building on those regulations, and it's broadening and widening the net to some extent because it's targeting the foundries, so TSMC and Samsung and Intel, so the companies that have these giant foundries that actually churn out and produce the chips, who have customers in China. And the net is widened by making this any chip below a certain level, so 14 to 16 nanometers. Anything below that is now considered within this additional set or thicket of restrictions. It's about putting additional sand in the gears, essentially, and to try and close some of the loopholes that Chinese companies have been using up until now to get around previous restrictions in terms of getting access, particularly to the AI accelerators and the GPUs. There are workarounds, though, for companies that are on certain lists, certain approved lists. And to your point, this is as well about compelling TSMC particularly, but also Samsung, to ensure that they do have the due diligence, they do have the checks, and that they understand what previous regulations are in place, who are on the blacklist, who are on the approved list, and to ensure that their chips are not inadvertently getting to Chinese customers that are not approved by the US, because that has happened in the past, particularly around Huawei secretly getting hold of chips that were manufactured in the foundries of TSMC in Taiwan.
Do you think the regime, Tom, for compliance has materially changed? We're going to have a new administration, and the question is whether the enforcers that they have are going to bear real teeth, or are there subtle workarounds here?
Since October of 2022, there has been a flurry of restrictions, as you know, Manus, this thicket, this web of restrictions. increasing the pressure every time, making it more difficult every time to get particularly the most sophisticated chips, but also the hardware and the software as well into the Chinese market. Now, there have been the workarounds, there have been the third-party buying, there have been the opportunities for those players in the Chinese market to get hold of some of this kit, but it has become ever more complicated. Those who critique this measure say, of course, what it does is just accelerate the domestic spend on R&D investment in the Chinese market to try and catch up to US players. We know the gap is there between the US and China. We know that on some metrics, it's starting to close, not the highest end, not the most sophisticated chips, not by a huge amount, but certainly when it comes to legacy chips, the next concern, and there have been some measures coming through from the Biden administration on that, has been a flood of legacy chips out of the Chinese market into the global markets. That is something that they're concerned about as well and are working on proposals. What we haven't heard from the incoming Trump administration is anything particularly clearly articulated in terms of whether or not they unwind some of these restrictions or build on them, because their focus, of course, is on seemingly more broad-based tariffs with all the uncertainty that's involved in exactly what they end up looking like.
Tom, let's just square off with Elon Musk. He's in the sightlines of Gary Gensler. Again, this is the closing days of the Gensler regime at the SEC. What is this lawsuit about? It's essentially about retail investors like you and I. If we were long Twitter, were we given the opportunity to benefit knowing the holdings that Elon Musk was building up?
Yeah, the allegation is from the SEC, the Securities and Exchange Commission, that essentially Musk dwindled those retail investors out of about $150 million because he built up that position without declaring it, now being transparent about that position build-up. And of course, when it finally came to pass that it built up a 9% stake, the stock soared about 27%. So within that period of the build-out of the stake, above 5%, prior to him releasing that information, of course, people were also mom-and-pop investors, institutional investors, selling Twitter stakes, and they made a loss, or at least they made less than they would have made if they had had that transparency around the information. That is the allegation from the SEC. Of course, Musk's lawyers have described this as a sham. They say it is part of a long-running, what they described as a harassment of Elon Musk. It sounds very much like they're going to be challenging this. The SEC tried to get $200 million out of Musk to address this and finalize this and end this scrutiny back in December. He's pushed back on that, his lawyers saying any fine should be much, much lower than that.
Yeah, pretty robust pushback from the lawyer. Tom, thank you very much. Tracking the tech stories there, Tom McKenzie. Let's stay with Washington. It's a busy old week in Capitol Hill. The cabinet confirmation hearings in full swing. Incoming President Trump's pick for Defense Secretary Pete Hegseth appealed to Republicans who can confirm him without bipartisan consensus. But Democrats held him up to scrutiny with their time.
Mr. Hegg said, I do not believe that you are qualified to meet the overwhelming demands of this job. We must acknowledge the concerning public reports against you.
Will you put your money where your mouth is and agree that when you leave this job, you will not work for the defense industry for 10 years?
Senator, it's not even a question I've thought about because it's not
think about it right now.
It's not one. My motivation for this job.
I understand
has never
that. I
been
just
about
need
what
a
could
yes or no
conceivably
here.
come next.
Time is short. I just need a yes or no.
I would consult with the president.
Let's get to Washington. Bloomberg's Megan Crane joins me. Megan, I mean, Elizabeth Warren there. I've had Damascene conversions, people tell me, but I've never heard of a nomination conversion. Of course, this is quite a serious issue around women in combat in the military. Look, Megan, I watched a lot of this yesterday. The allegations were hard and heavy on his excessive drinking allegations, and he denied these on sexual assault, on financial mismanagement in his not-for-profits. So it very much was a partisan blow-by-blow go at Hegseth. How do you think the Republicans will rally around him? Because the chair of the committee came out with a glowing report at the end.
Good morning. Yeah, so it was very much a partisan exercise. The Democrats took the opportunity to highlight all the negative news about Hegseth, and the Republicans really rallied to his side. I think the most important one was Joni Ernst, who is a combat veteran herself, and was really sort of the question mark as to whether he would get enough Republican support. And she, asked him some questions about women in combat and, really gave him the opportunity to take back the words that he said recently about women in combat, and that really sort of sets him up, I think, for a pretty easy nomination at this point.
And this is where he did push back and qualify time and time and time again, which was about the standards that were applied in the military for women in combat units and a watering down of those standards in his view. The other narrative was this, is about your experience. It's 3 million people, it's a huge budget, a huge organization, and he lacks that sort of material knowledge of how to run it. But you know, what would it mean for the defense industry if he does take on this role? Because he talked a lot about technology, imbuing the Pentagon with technology and shifting the dial, really, in defense.
He did, yeah. He definitely highlighted his interest in growing the military, in shipbuilding, and you know, technology specifically, and sort of refreshing the technology and bringing innovation to the military. There weren't a lot of specifics on how that would work, but it would be good news, you know, for the defense industry, for someone who wants to sort of bring that investment to that part of the government.
So today we've got a roll call on Capitol Hill. Kristi Noem, Secretary for Homeland Security. Marco Rubio, Secretary of State. Chris Wright, he's of Liberty Energy, for the Secretary of Energy. So these are all the prospects in front of us now. Rubio is going to be really interesting, because this is probably our first understanding of, again, some kind of a qualification of what America first is, in his own words.
Yeah, it will be interesting to hear how Marco Rubio puts that forward. He's a longtime China hawk. He definitely will not have such a contentious hearing. He is a longtime senator, has really worked in the foreign affairs space for quite some time. So, you know, it'll be more of an opportunity, I think, for the Republicans and Democrats to sort of make statements and put out their own interests in the public, you know, domain, take an opportunity while they're on TV. I'm really interested about Pam Bondi's hearing, who's, you know, up for Attorney General after Matt Gaetz had to withdraw. She is traditionally qualified. She's the Attorney General of the state of Florida. But, you know, she's a longtime Trump ally, and there'll be a lot of questions about her ability to stand up to him, or her ability to act independently and maintain an independent Department of Justice.
Well, that was certainly one of the big themes yesterday during the Hegseth hearing, in terms of accepting orders and executing orders from a president that as defense secretary you may not necessarily agree with. So it was about truth to power. Megan, thank you very much. Right. Megan Crane in Washington. Day 2 of those hearings. We'll have it all covered. Let's pivot to Wall Street. 4 banks are slated to report their earnings this morning. Sonali Basak is the Queen of Wall Street. I don't know who the king, the Dawn of Wall Street is probably Jamie Dimon. The Queen of Wall Street on the banks is yourself. Good morning. Good to see you.
Good morning.
So this is going to be a question of whether we had good volatility, bad volatility, or just splendid Trump volatility in the final quarter. Lay out the roadmap. It's supposed to be quite a beefy and substantial earning quarter for the banks.
Very substantial. And knowing already that trading revenues are supposed to be up across the street, for the top 5 banks, they're supposed to post the best quarter in 5 years. Net interest income is also supposed to be coming in quite rosy. The problem is it going to this year? For JP Morgan, they tend to lay out an outlook for the year. For the past year, they had said they expect to have the full year net interest income revenue of roughly $92 billion. Can they surpass that in 2025? Now, interest rates have not dropped as much as expected. The yield curve is steeper. And so does loan demand meet the ability to bring in more net interest income at these levels? Also watching, of course, charge-off rates, because at this part in the cycle, we know lower-income consumers have been weakening, but has that drifted into middle and higher-income consumers as well? Is there some deterioration?
I mean, that typically is one of the canaries. And JP Morgan and the commentary that they make around the consumer and what Jamie Dimon has got to say or on that call is particularly important. On the investment banking side, if you look at Goldman's, I mean, the expectation is what? A 30% increase in global investment banking. You've got pretty healthy debt and equity capital markets. But it's more about what the roadmap for this year really looks like. We're going into a new political regime with deregulation. Everybody's hoping for this boom in IPOs and debt and equity capital markets.
The incredible thing, we spoke to UBS's Erica Najarian just yesterday, and she doesn't believe that the bank rises could be priced in at this point based on what you could see in terms of regulatory relief by lighter Basel III standards. Now, what does this mean? Interesting anecdote, for example, we spoke to Bruce Richards over at Marathon. End of last year, he said because banks have more capital on hand, they had hoarded all this capital in anticipation of those rules. They are now lending lending that out. They're not only lending that out, they're lending it out to private credit firms that are then going across the economy and lending that out even more. So leverage is alive on Wall Street here. The interesting thing, too, is you've seen capital markets take off already. You've seen leverage loans come back at scale. The question is, you still have a CPI print today. A lot of these issuances have been front-run ahead of critical economic data because of volatility in the bond market. You asked a little earlier, was volatility stifling? The answer so far has been no. And we haven't seen August-level volatility in the stock market either. So volatility has been the friend to Wall Street. Look at this year. Commodities are coming back, too, in terms of volatility. So that reaps good news for these big investment banks.
Well, certainly Mike Mayo over at Wells Fargo, I mean, he's hoping for a paradigm shift in terms of the earnings. We'll count you down. We'll both be together. I'll break them. You'll take the team through them. It'll all be on surveillance. Sonali Basak setting the tone for the earnings from the banks on Bloomberg. We'll set you up for your trading day. It is CPI day as well as Bumper Banks Day.
Day. Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's Bloomberg Brief. I'm Menace Cranny in New York. This is what the rest of your day looks like. As we said, big bank earnings, JP Morgan, Wells Fargo, Goldman Sachs, and Citi all before the bell. Main event of the day is US CPI. That hits the tape at 8:30 a.m. Eastern. The consensus there is around plus 0.3%. And the confirmation hearings continue for Secretary of State, Attorney General, and a number of others, all on deck on Capitol Hill. The bond market will be the ground zero for reaction to the CPI. As I say, we've done our survey. Around 39 in that survey expect a rise of plus 0.3% on the core. 32 expect plus 0.2%. So what we really have here is this bond market just ticking down ever so slightly. You did make the highest level since 2023 on the 10-year paper and on the 30-year paper as the five-year inflation expectations pushed through the 2.5% level last year. But just a conversation with Schoenfeld on this show, they see value at the very, very short end of the curve. I'll join the surveillance team. We'll break those bank earnings for you, along with Shanali Basak on surveillance. The team up ahead.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We've had some reports on inflation and inflation expectations which weren't great. If that continues, that could cause the consumer to pull back.
With inflation sticky, growth strong, we just didn't see scope for the Fed to be cutting rates this year.
Inflation will be sticky. We'll basically be living with a high inflation target.
In our view, slowly but surely, it is heading close to 2%.
What we're seeing right now is the biggest catch-up in history between soft data and hard data.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday on a pretty mild two-day winning streak. Your scores look like this on the S&P 500. Equity futures positive by just 0.2%. Likewise on the NASDAQ. Check out the bond market. On a run of 8 consecutive days of rising 10-year bond yields, the longest such streak going back to 2022. This morning on a 10-year, look out below, we're down 2 basis points. The mercy of the price action today is all on this. The earnings a little bit later, we'll hear from JP Morgan, Citi, Goldman, Wells Fargo, and on the data side, Anne-Marie, US CPI.
CPI is really going to be the star of the show this morning. I go back to what John Author said 2 days ago. We were at this point really supposed to forget about CPI. It was trending down. The Fed was cutting rates, but now everyone is starting to worry about expectations of what Trump 2.0 might mean for the inflation picture. We know we talked about University of Michigan. It's colored with the, politics, but they are finding that expectation for inflation in 5 years are now higher than they ever were during the spike in prices of 2022. And that expectation is that self-fulfilling prophecy of potentially higher prices.
The most important data point this month, not payrolls, not CPI. Inauguration on January 20th. I think this market is bracing for that and a stream of executive orders.
That's why I think the market reaction to today will be so interesting. Will it be a redux of PPI where we basically get the number in and we say all this is a jumping off point for inflation to come, that we're more worried about the future. So even if you get a number that's in line, you could still have a treasury market that refuses to rally because we care about what happens next week. Everyone says we need uncertainty to clear up, but who's to say uncertainty won't be sticking around even after next week?
Well, it's the politics that are driving this economy. The political economy for 2025 is going to be so important, and we've seen that play out over the course of the past week. This market just whipsawed by different trade tariff stories coming out. Is it going to be gradual? Is it going to be narrow? Is it going to be blanket? And that already is fueling this uncertainty. When it's uncertain, you have to start pricing that in.
We've had 3 over the last week. The Washington Post, CNN, us here at Bloomberg in the last 24, 48 hours or so. Only one voice matters, and you'll hear from that man a lot, the incoming president of the United States, Donald Trump. Got lots of earnings this morning. This comes from BlackRock. Fourth quarter EPS, 11.93. The estimate, 11.46. On assets under management, some huge numbers. A little bit lower than expected, 11.55 trillion. Still massive. The estimate, 11.66. More on the numbers a little bit later. Equity futures right now in the S&P positive by 0.2%. Coming up this hour, we'll catch up with Andrew Sheets of Morgan Stanley ahead of fresh inflation data. James Lucier of Capital Alpha Partners as Trump floats creating an agency to collect tariffs. And Gerard Cassidy of RBC as big bank earnings kick off on Wall Street. We begin this hour with stocks steady ahead of CPI at 8:30 Eastern Time. Investors looking for clues on the Fed's rate path. Andrew Sheets of Morgan Stanley writing, we think CPI will show a downtick in core inflation and support the case for a March Fed rate cut. An elevated reading would put that view in jeopardy. Andrew joins us now for more. Andrew, welcome to the program, sir. Lots to get through this morning. Bank earnings and data as well. Had a big backup in Treasury yields over the past month or so. Do you think we're in the so-called buy zone right now?
Yeah, so I think we're pretty close to it. I mean, certainly if we take a longer-term view, our forecasts at Morgan Stanley are very much for global bond yields, including Treasury yields, to decline. We have more Fed rate cuts in our forecasts than the market. We have them happening sooner. And we do think that inflation readings in the first half of this year will generally be declining. And there are a variety of reasons for that, but part of it is our read on incoming Trump administration policy, that we think that policy might be announced quickly, but the implementation will be slower, and so it will slow up. It will show up somewhat slower in the data. So I think if you get all those factors, and again, today's CPI reading is pretty key, that should lead to pretty good total returns for bonds on our forecast over the next 6 to 12 months, and creates a pretty attractive case. Now, today's CPI reading is important for that view, and obviously we need to see, we're going to get a lot more information, as you were talking about at the onset to this program, about the administration in the next week. So we need to keep an open mind, but on our current thinking and our current numbers, we think bonds look pretty attractive here.
Andrew, can we just sit on the why you think we have backed up in the fashion that we have over the last few months? I was reading through your research and you offer 2 choices, pricing in stronger for longer, or are we discounting a greater fiscal premium? Which one do you reckon it is?
Yeah, so I would be in the camp, and a lot of my colleagues are in this camp, that we're pricing in a stronger U.S. economy for longer. You've had a steepening of the Treasury curve, you've had higher real rates, and you've had some pretty good data. You had a strong U.S. jobs number. President Biden is going to exit as the first president to never have a negative NFP number on his watch. And Atlanta Fed, real-time GDP for the fourth quarter is exiting the fourth quarter pretty strong. So I think you've had strong data, you've had yields going up on the back of strong data, the curve steepening, higher real rates. I think that's all a pretty internally consistent story of the economy is somewhat stronger than the market was expecting. The other caveat we have to remember here is think back to last January. January can be a time when the market overreacts a little bit. And last January, the market priced in, with hindsight, way too many Fed cuts, way too early. And if I think about where the market's pricing versus our current economic forecast, we think the market's now pricing too little from the Fed relative to what we think they'll ultimately deliver.
Andrew, why don't you buy the idea then that there's some sort of uncertainty premium that's being built into yields, the uncertainty of fiscal policy, the uncertainty of what we might get on tariffs and deportations, and that's commanding richer premiums. Is that not part of the story?
Well, that's a fair point. I mean, I'm sure that's some of what's going on, and that might explain some of the move. We don't think it explains it all, but I guess where we kind of have some difficulty with that explanation, or that explanation, explaining the bulk of the move, is first, we don't actually expect very large fiscal shifts very quickly in the U.S. We just don't think the Republican majority in the House is large enough to accomplish those things, or at least accomplish them quickly. And I also think that those risks are somewhat two-sided for Treasury yields. Yes, if you see more aggressive tariff or immigration policy sooner, that could drive up inflation. And indeed, we would expect it to drive up inflation. But it could also weaken growth. And in an environment where growth is weakening because you have more disruption in the labor market, because you have more disruption through trade, well, that could argue for yields being lower as growth is disrupted. So we think that those risks are maybe a little bit more two-sided from the policy uncertainty than the market is currently reading.
Even so, that move higher in yields did have the ability to spook equity markets. But Andrew, the weird thing about it is that credit wasn't shaken at all. On Monday, when you had 10-year yields move higher, something that maybe should have disrupted it, you still had $15 billion worth of issuances. Yesterday was much of the same. Why is this credit market not reacting?
Yeah, that's exactly how we're seeing it. You have a very solid, a very strong credit market. And I think there are a couple of reasons behind that. I think first is, this is a credit market that I think a lot of investors would describe as a good yield and kind of a bad spread. Yields are quite high, nominal, real, relative to history on the corporate indices. Spreads are low. And I think a lot of the buyers of credit at the moment are more yield driven. They're buying it because they like that yield. They like 5.5% on U.S. investment grade credit. And they're not as sensitive. They're not buying it for the spread. And so I think that allows the market to be a little bit more independent from what's going on. And, I also think that you have still a backdrop where corporate aggressiveness is picking up, but it's nothing too extreme. I think we haven't yet, we have seen M&A picking up, but we're not hitting the levels of corporate aggression, of releveraging that we think are really yet going to worry credit investors. And I think those are both quite important factors. And then you can maybe layer on a third. We talked initially about, look, there are two ways to read what's going on in the bond market. Maybe it's concerns around fiscal uncertainty. Maybe it's a stronger economy. Well, if it is a stronger economy and a stronger for longer economic expansion, that I think would be very consistent with the credit market liking that and being somewhat more relaxed.
Andrew, if we could just go back to the fiscal uncertainty, I hear you that the Republicans have such a slim majority, historically the slimmest they've ever had in the House of Representatives. But if they don't move on tax policy, TCJA does not get extended. They have no choice but to move. So what are you baking in that gets done out of Washington this year in 2025?
So we are thinking, we do think there will be an extension done, but ultimately, we see that as more of the status quo, i.e. you currently have those taxes, those lower taxes, those tax cuts in place. They get extended. So yes, it is, the deficit stays wider, but it's not necessarily a large change versus current policy. And again, that's one of the reasons why we don't think it might have such a large impact on yields or uncertainty premium. And then again, I think we ultimately think that the scope beyond that extension is maybe somewhat more limited because you have, as you correctly mentioned, such a historically small majority. And I think even within the GOP caucus, there's not necessarily agreement on the level of fiscal expansion. So we have to keep an open mind. We have to, I think we're going to learn a lot, I think, over the next month about where that majority actually sits and what is possible. But in our baseline, we don't have such a large fiscal change. And that's one of the reasons, one of several reasons why ultimately at Morgan Stanley, we're forecasting yields lower on the horizon rather than higher.
Once they figure out the sequencing, then they'll start to talk about actually what it looks like in terms of top line figures. I've heard anything from under 2 trillion to maybe as high as 6 trillion. Do you have a forecast, or do you think there is a level that at some point this bond market can't handle?
So, look, I think this is a question that is again, I think over the next several months, we're going to get a lot more information and we're going to have to be adaptable to it because, as you correctly mentioned, throughout the election, there were very wide range of forecasts around GOP budget proposals. And a lot of, I think, kind of disagreement around what sort of cuts are possible to offset potential tax cuts, and also what sort of revenue-raising scenarios are realistic. So I do think first, and I think this is the most important factor, it's less about the number, but it's more, I think, about how the market sees the realism of either those cuts, spending cuts actually being enacted or taxes actually being raised. And spending cuts are difficult. Most of the U.S. budget is to the military and to entitlement programs, both of which are very popular among the voting public. And so, again, that's a reason why we're a little bit more skeptical that cuts can get done, and thus we're a little bit more skeptical that you can get large additional tax cuts because there's not the offsetting spending cuts there to do it.
Andrew, just wanted to finish on the financial sector with you. Speed kills. The Fed moved fast and broke things back in 22, 23 in the banking sector, but persistently high rates as well can cause pain too. And I just wonder, Andrew, from your perspective, whether corporate balance sheets have the capacity to weather the storm, because there was a conversation for a long, long time about surviving until 2025. Well, 25's arrived and people are talking about no rates at all. So I'm just wondering from your perspective whether we can handle that.
Yeah, Jonathan, I think we can, and part of that's because corporates have termed out their debt significantly. Part of it is, on our analysis, corporate interest coverage, their ability to pay for that debt's been now pretty stable for several quarters, so corporates have had time to adjust for this level of yields. I also think if we go back through history, it's often been modest Fed cutting cycles that have been the best for credit. That soft landing that a modest rate cutting cycle represents is much better to more cuts, but a lot weaker growth. Now, we don't think that applies to everything. Our year ahead outlook at the end of last year, our U.S. credit strategists, they turned cautious again on U.S. CCC credit. That rallied a lot to end the year. I think it's some of the weaker parts of the market that are more vulnerable to higher for longer. And I think a trend, a theme at Morgan Stanley generally, even to my colleague Mike Wilson on the equity side, is quality is a pretty important factor here, and up in quality can still make sense if the premiums to do so are reasonable.
Andrew, appreciate your time, sir. Always good to see you. Andrew Sheets there from Morgan Stanley on a big morning here stateside, 8:30 Eastern Time, US CPI. Before we get there, earnings from JP Morgan, Citi, Goldman, Wells Fargo, all coming up throughout this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. Southern California faced another night of extremely critical fire conditions due to high winds and minimal humidity, leaving 10 million people at risk. The fires have already claimed the lives of at least 24 people and have burned down more than 12,000 buildings. The Biden administration is planning to unveil more rules aimed at limiting exports of advanced chips to China. Bloomberg has learned the White House intends to announce the measures in the last few days of the Biden administration. The new rules will target chip producers like TSMC, Samsung, and Intel. And Volkswagen is bracing for another difficult year. Sales for the German car maker are expected to decline in 2025 due to a lack of new electric car models amid delays in software development. Plus, the company has struggled to compete in China, where local manufacturers are dominating the market with affordable electric and hybrid models. Volkswagen CEO is working to restructure the company, but new models won't be available until later this decade. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, bracing for tariffs.
In terms of the economic policy writ large, there are more questions than answers at this point. While Transaction Man is going to be there, Tariff Man will also be very much present. We are preparing for increased tariffs.
That conversation up next. Live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Got a big couple of hours coming up. It starts this hour. We're looking for numbers from JP Morgan in the next 40 minutes or so. Before we get there, equity futures right now positive by 0.2%. And check this out. 8 days without falling yields on a 10-year yield. This morning, they're falling. We're down by 2 basis points. Let's see if this holds. The 10-year, 4.7698. Under surveillance this morning, bracing for tariffs.
In terms of the economic policy writ large, there are more questions than answers at this point. Don't underestimate President Trump in terms of how deep-seated this ideology is. He's been talking about tariffs since the 1980s. While transaction man is going to be there, tariff man will also be very much present. We are preparing for increased tariffs.
So here's the latest this morning. World leaders in business preparing for President-elect Donald Trump's expected tariffs. Trump proposing an external revenue service to collect tariffs on foreign imports, writing on Truth Social that foreign sources will finally pay their fair share. James Lucia of Capital Alpha Partners joins us now for more. Now, James, I'll kick this off with a dangerous question. Can you make sense of that? Does it make sense?
It's typical Trump riffing. He is trying to upset people and set things up for whatever transactional bargaining strategy he has. The fact is we already have an external revenue agency. It's called Customs and Border Protection. So think about the Jerusalem Embassy, formerly the Jerusalem Consulate, with a new sign on the door. Think about the Space Force, which is another office in the Pentagon, again, initially with a new sign on the door. So he can call it what he likes, but the reality is there's nothing really changing here.
So this is a branding exercise. Is that what you're saying, James?
I think it's a branding exercise. It's also something of a mind game. Personally, with regard to taxes, I can tell you there is no $10 billion tax cut coming, not even a $6 trillion tax cut coming. It might be two, and it might not come until December or October. So market expectations are out of whack there. Similarly, there's going to be no across-the-board tariff. I do expect some tariffs from Trump. I expect probably a scary tariff memo when he does his day one executive orders, but we're probably going to see much more selective activity, sector-specific tariffs, I think, from Trump.
Well, James, I think we can learn a lot from what Trump says and what he doesn't say. He did not come out like he did with the Washington Post article about tariffs and say that is fake news when it comes to the reporting from my colleagues, Jenny Leonard and Saleha Mohsen in Washington, D.C., about a gradual approach to tariffs. But then he did come out and say External Revenue Service will be this new department that collects our tariffs and duties. So there's still a lot of emphasis on tariffs at the moment from Trump. But what you think that you can read between the lines is that this is going to be more narrow and targeted and smaller incremental increases?
I think there is more bark than bite here. And I think that just as the narrow, rickety House majority limits what can be done on taxes, frankly, that also limits what Trump can sustain politically on across-the-board tariffs, too.
Can I ask about this tension, James, this idea that it's more bark than bite? The idea, as you say, we'll get a scary tariff memo. Because there needs to be a seriousness from Trump for Europe, for China, to pay attention to what he's saying. But implicit in that is that investors trading in this market are kind of like, well, we're smart enough to see through that. We can see through the bark, but for some reason, the European officials and policymakers won't be able to. Is there not somewhere where rubber needs to meet the road that in order to be serious to his partners, it also needs to be serious to the markets?
Well, I'm just back from a week in Tokyo. I can tell you that the Japanese attitude towards Trump's tariffs is much more pragmatic, and it's much more similar to the attitude we see in New York, where it's wait and see. How much of this is bluster? We really don't know. It is remarkable, or at least on my last trip to London, it was remarkable to the extent to which UK and European investors I talked to were taking every word literally and preparing for a massive US-European trade war. You need to realize that Trump has a particular target in mind. It's China. It's not the European Union. It's not the UK. And you should bear in mind that they are ultimately going to be the center of the strategy, whatever that strategy emerges to be.
What is his goal in Europe then? Because we've heard Trump talk a lot about it, to the extent of speaking with Bloomberg saying he's potentially more worried about his allies than others.
Well, that's true. If you go back to Trump's early career, as you mentioned on this program, I mean, Trump once took out a full-page advertisement in the New York Times excoriating Mercedes-Benz for importing cars into the U.S. at very low tariffs. That's a long-time theme with his. I think that in Washington there is just an intense feeling of irritation, even outrage with European regulatory programs, whether it is AI, whether it is privacy, whether it's international taxation, whether it's a whole host of other areas where the European view that the EU can be a regulatory superpower is going to start facing some serious blowback in Washington. And I would see the use of tariffs as a way to start deferring or deterring things like that overreaching regulation or digital service taxes or similar proposals.
James, there's one deadline they need to deal with, or it can have serious market consequences, and that's the debt limit. And based off a few days of reporting in Palm Beach, the sense I got was that Trump wants this out of reconciliation. Will they have the Republican votes, or are they going to have to rely on Democrats to get this through?
I don't think they have a plan. Obviously, in Washington this week, the Republican leadership are briefing their members in conference meetings, trying to come up with a plan. But they have members like Chip Roy and Tom Massey who have never voted for a debt increase. I think it's something of a desperate effort to say that we're going to tie the debt limit increase to the aid for fires in California. The reality is that they don't know what they're going to do here. But I will make one prediction, and I think that we are seeing the last days of the debt limit. This is a completely anachronistic, irrational policy that dates from 1917. I'm not going to predict that the debt limit is eliminated or abolished this year, but I don't think we're going to be seeing it very much longer just because it is an intractable problem. And just as Nixon went to China, you're going to see a Republican president come out, as Donald Trump already has, saying that we should simply abolish the debt limit or, frankly, restructure the debt limit the way David Malpass proposed in the pages of the Wall Street Journal last month, making sure that there is no default, setting the debt limit in terms of percentage of GDP rather than dollars, and making a number of other common sense reforms to make sure that we're focusing on managing the debt and not just political theatrics every time this debt limit needs to be raised.
Hey, James, appreciate your time. James Lucy there of Capital Alpha Partners. Mentioning David Malpass, who was on this program the past week or so, making that argument.
Making that argument, and also I think that a lot of Democrats would welcome this idea that you want to abolish the debt limit. It always ends up being this 11th hour deal. Financial markets care about it. They always end up raising it, but it's all this negotiation, backroom dealing for something that they know they're going to do. Trump wants to get rid of it. I will say, I think there is some individuals in Washington irked by the fact that they're dealing with this at the start of 2025, and the decks weren't cleared for Trump when he came in.
Everybody's a fiscal hawk when they're not in power. That's been a story of Washington, D.C. for the last couple of decades, that's for sure. In just a moment, about 20 minutes away, we're looking for numbers from J.P. Morgan, expecting earnings from them by about 7 a.m. Eastern time. Then after we get through the bank earnings through this morning, 4 big banks reporting, then we can shift our attention to CPI, inflation in America at 8:30 Eastern time. Going into that, equity futures positive here by 0.2% on the S&P 500, and bond yields just a little bit lower. Up next on the program, we'll catch up with Gerard Cassidy of RBC as earnings season kicks off on Wall Street. From New York, this is Bloomberg.
is the Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that just empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Lots to get through, plenty to get through this morning. In the next 30 minutes or so, earnings from JP Morgan to kick off earnings season on Wall Street. Then later on, 2 hours from now, CPI in America. Your scores going into it look like this. 2 days of mild gains on the S&P 500, up again by just 0.2%. On the Nasdaq, up by 0.2. On a Russell, up by 0.4. The small caps helped out by this. Switch up the board, turn a page and get to the bond market story. 2-year, 10-year, 30-year. Yields down by 2 basis points, 477. We've had an 8-day run, Danny, 8 days where yields have not fallen on a 10-year Treasury.
And based on what I think is the important question here, because there seems to be percolating this idea that it's no longer about pricing out cuts. It's no longer just about economic strength, but that it's about pricing in some inflation. What inflation are we pricing in, John? Because prices paid rose on ISM, because just airlines were higher on PPI. The only thing you can really turn to is, do we not care about this current environment? And we're just looking forward to what happens after next week.
We were talking to Andrew Sheets moments ago, and you said something important, the price of uncertainty. This is something David Kelly of JP Morgan will talk about with us a little bit later. He believes the price of uncertainty, not knowing what these policies will be, is higher bond yields.
I've seen so much commentary saying the way that this bond market finally settles is post-inauguration when we have some certainty. That's an issue because there's this idea that unpredictability is a feature, not a bug of Trump's policy. So we might continue to have this era of uncertainty and then higher premiums that you need for that.
That was the buzzword in Palm Beach, unpredictable. He wants to keep everyone on their toes, not just adversaries and allies, but I'm sure also this market, whether it's the stock market or the bond market. So if you think just because he's swearing on a Bible Monday that we're going to have some sort of clarity, think again.
He's going to stay unpredictable for the next 4 years. Let's turn to foreign exchange. Euro dollar's a snooze, it's going nowhere. 103.07. Sterling. They get some good news in the UK. Inflation comes in just a little bit softer than expected earlier on this morning. The pound 122.28. And dollar yen. Some yen strength here. Dollar yen 156.90. We had Mizuho's Jordan Rochester on the program in the last week or so, and Jordan making the argument that he thinks the next BOJ meeting is a live one and that they might hike interest rates, and BOJ officials are starting to line up behind that idea.
But I wonder if they're even certain of it until after today and after the inauguration. This might be a Ueda who maybe wants to hike, wants to get that done, but isn't going to do it until we get figures from the U.S. and a greater clarity of what's happening in the political situation. It's what's dominating the yen, it's what's dominating gilts, it's what's dominating the pound. There is so much that hinges on the U.S. right now.
Dollar yen, 156.88. Under surveillance this morning, investors counting down to December's CPI at 8:30 Eastern Time. A Bloomberg survey showing the core print rising 0.3% alongside a 0.4% advance in the headline number. The data are expected to boost the case for an extended pause in Fed rate cuts after the payrolls report on Friday put to bed the idea they'll be cutting rates anytime soon.
I think it's going to be an interesting litmus test for this market. Will bonds actually rally if we get in line or a little bit softer? If we don't rally, it could be this idea that we've been talking about that we almost don't care about the present environment, that the present environment, as uncertain as it might be, is just a jumping off point for what we might get with more inflation. Ian Lingen over at BMO says that you need a much bigger downside surprise than just 0.2% in order to actually get treasuries rallying.
I wonder what kind of inflation print, though, we get, that people start actually, instead of saying the Fed's on pause this year, they start saying, ooh, the Fed might actually have to hike this year to tame inflation that we see. And that would go back to what Adam Posen told us last year, about 6 months ago, saying that was his big concern.
That's the latest on that front. More on inflation through the next 2 hours or so. The report drops at 8:30 Eastern Time. Wanted to get you up to speed on this story here. The SEC filing a lawsuit against Elon Musk, claiming Musk cheated Twitter shareholders out of more than $150 million by waiting too long to disclose his growing stake in the company as he prepared a takeover bid. Musk's lawyer saying the lawsuit is a sham and Musk did nothing wrong.
So basically what this comes down to, I believe, is a day. He had 10 days. He waited 11 to disclose this. What I find interesting, of course, is the timing. Chair Gensler is exiting, stage left, if you will, and then we're going to have Paul Atkins come in. And given the proximity that Elon Musk has to power, to the White House, to the president-elect, he's likely going to ask the incoming chair, you can imagine, to withdraw the case. So I still think this is a TBD situation.
Watch this space. Another story where we're waiting for a conclusion. I want to return to this. Returning Santa Ana winds and dry conditions threatening to expand wildfires across Los Angeles with more than 10 million people at risk. About 88,000 residents remaining under evacuation orders and almost 85,000 under warnings. Heather Zare of AccuWeather joins us now for more to discuss. Heather, welcome to the program. What is the latest on this front?
Hey, thank you and good morning. Well, so far the winds overnight have not been any stronger than they were during the day yesterday, which is to say that most of the wind gusts have been between 40 and 60 miles per hour. So that's good news and allowing a little bit better progress to be able to make in containment of those fires. The interesting thing with the wind has been that we've actually had around the Palisades fire offshore winds in the vicinity of Malibu that is blowing from the land out onto the ocean. However, on the eastern side of the fire, the wind has actually been a little bit onshore, so that's helped a little bit in firefighting efforts there.
So the wind is one thing in the expansion of these fires, Heather. What about just the starting of new fires? That's one of the features, unfortunately, that we've seen of this, that every place feels like a ground zero for a new fire. Are there more threats and more conditions that could cause that to happen? And again, just more growth in the area under stress?
Unfortunately, that is still the case for today. We are still expecting an extreme fire risk. It remains very dry. They've had very little rainfall over the course of, well, really since last May. They've had only 0.16 inches of rain in downtown Los Angeles since the beginning of October, which is considered the start of the wet season. Unfortunately, that has allowed the fuels that are prevalent after a couple of winters of good rainfall to be able to really dry out. Then you kick up these winds, you have very low relative humidity, and unfortunately it does lead to these extreme conditions where fires can easily start and quickly spread.
Heather, appreciate your time. Heather Zare there of AccuWeather. The story to watch down in Los Angeles, and they're still waiting for a big break.
They are waiting for a big break, and just listening to Heather there, it doesn't sound like it will come from the rain. It's part of one of the really unfortunate things of what we've seen both in these wildfires and the other weather events we've had this year, is that because it's an unpredictable path, you have people that seem to be often caught off guard by this. Some of the sort of warning signs, the flags, the particularly dangerous situations that they issue don't really help. It's a little bit of confusion in how they actually communicate this. So the risks are still there, and it's people who maybe don't fully realize until this moment the calamity of just how big it could get.
We'll be following this story throughout this morning, of course, on Bloomberg TV and on Bloomberg Radio. Just turn back to the story in financial markets today, 8:30 Eastern Time. We get inflation data. Before that, we get tons of bank earnings, including from JP Morgan and Wells Fargo, kicking off the big bank results on Wall Street in the next couple of moments. Both expected to report by 7 a.m. Eastern Time. Jared Cassidy of RBC joins us now for more. Jared, welcome to the program, sir. Love doing this with you every quarter. Let's look ahead to JP Morgan first. What are you focused on in the next few minutes?
I think what we're focused on is how strong the investment banking and capital markets businesses are for JP Morgan. But second, and maybe more important even that, John, is the net interest income guidance. As you know, in the fourth quarter, the banks like JP Morgan will give us the 2025 guidance. And I think the key number for the guidance number for JP Morgan Chase is going to be net interest income. And as you know, John, a positive slope yield curve is very positive for net interest income for all the banks, including JP Morgan.
Well, it is, to that point, Gerard, going to be the first time in almost 5 years that we have banks reporting results with lower rates already in hand. Is there any immediate impact that we will have seen from the cuts already done by the Fed?
I think there are. I think what you're going to find is that, of course, some of the earning asset yields will come down for loans that are tied to the short end of the curve, like a corporate loan. Partially offsetting that, however, is any of the fixed income instruments purchased in 2020 and 2021 as they roll over in the as they did roll over in the fourth quarter and will continue to roll over in 25 and 26. They'll roll over into higher yielding earning asset yields, even though the yields have come down from, of course, the highs of September. And then most importantly, funding costs, deposit costs, those are coming down. And I think what we're going to hear is that those costs may be coming down a little faster than expected.
So that's one portion. The other big bonanza we're expecting is trading. And on this, Bank of America's Moynihan had said that the firm's sales and trading team had its best ever quarter. Are we expecting that across Wall Street?
Generally, yes. The rising tide lifts all ships, and oftentimes when one bank comes out and talks about the strength in trading, the others see it in their numbers as well. So I think you're going to find that we're going to have robust trading results for all of the big banks. And then the question is, how will that play out into 2025? And increased volatility, of course, is something that's always positive for trading results.
Gerard, stay close. We'll get a first look in just a moment. Waiting for numbers from JP Morgan and Wells Fargo in the next few seconds. Look out for those numbers. Before we get them, we'll get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Israel and Hamas have reportedly agreed in principle to a draft ceasefire. CBS News cites Arab, U.S., and Israeli officials saying the deal could be finalized as soon as this week. Both President Joe Biden and President-elect Donald Trump earlier said they were optimistic a truce was close. Israeli officials say the first phase would include a 42-day ceasefire, the release of some Israeli hostages and Palestinian prisoners, and a buffer zone in the Gaza Strip. Meanwhile, UK inflation unexpectedly cooled in December, slowing for the first time in 3 months. The data calmed market jitters around the country's economy, sending yields lower, though they're still at elevated levels, while traders raised their bets on interest rate cuts this year. Meanwhile, South Korea President Yoon Suk-yeol has been arrested. Authorities launched a pre-dawn operation to bring the impeached leader in for questioning over his short-lived martial law declaration. The arrest came after Yoon repeatedly defied summons to appear for questioning. Investigators abandoned their first attempt to detain him on January 3rd after a nearly 6-hour standoff due to resistance from Yoon's security team. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, bank earnings on deck.
Overall, pricing is still very favorable for banks, which is going to allow the net interest margins to rally both in the quarter reported this week and next week, as well as what the outlook's going to be for the first half of the year.
Just around the corner, numbers from JP Morgan and Wells Fargo from New York City. You're watching Bloomberg TV.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Live from New York City this morning. Good morning to you all. 8:30 Eastern time, so a few hours from now we'll get US CPI. Equity futures into that positive by about 0.25% on the S&P 500. Bond yields a little bit lower, down 2 or 3 basis points, 4.7657. Before we get to that inflation data, under surveillance this morning, bank earnings on deck.
Overall pricing is still very favorable for banks, which is going to allow the net interest margins to rally both in the quarter reported this week and next week, as well as what the outlook is going to be for the first half of the year. So that combined with loan growth accelerating from the Fed data in the months of November, December is very positive for the sector at this point.
So here's the latest this morning. Big bank earnings kicking off today with results from JP Morgan and Wells Fargo due out momentarily. Standing by with us, Gerard Cassidy of RBC, Shanali Basak of Bloomberg alongside us as well. Gerard, I want to come across to you before we get these numbers from JP Morgan, and when they drop, I will jump in, so forgive me. I want to talk about succession planning, Gerard, and the news of the last 24 hours and how you reacted to that.
I think, John, it was not too surprising. Daniel Pinto, when he was moved over to this chief operating officer role a little over a year ago from the head of capital markets, we all knew he was, about the same age as Jamie Dimon, and he was really never considered the heir apparent. It was really Jen and Marianne Lake were the two, I think, leading horses, and now Jen, of course, is going to be the chief operating officer, and Marianne Lake runs the largest division of JP Morgan, or one of the most important divisions, which is the consumer banking business. And a couple of the other executives that are heading up the commercial and investment bank will also maybe consider heir apparents as well.
Jared, still waiting for JP Morgan, but just getting Wells Fargo, so just hold on a second. I want to cross over to Manus Cranny for more. Good morning, Manus.
Hey, Jonathan, good morning to you. It's a beat for Wells Fargo, $11.84 billion on the net interest income. The estimate out there was for 11.7. As you and Danny have been chatting about, this is about reporting in the first series of rate cuts that we've seen for 5 years. Charge-offs at Wells Fargo, which is always an interesting one, comes in at $1.21 billion. That is their net charge-offs. But the guidance for 2025 in terms of net interest income, and this is what the whole of the street is going to be looking at, is expected to be about 1 to 3% above 2024. So that's a comfortable beat on the net interest income at Wells Fargo and a guidance of 1 to 3% above 2024. Shall we dive into JP Morgan? We're just getting some of the numbers coming across the terminal now, Jonathan. We've got JP Morgan, the fourth quarter. I'm going to jump in straight to the charge-offs because it's pretty much in line. The charge-offs are $2.36 billion. The estimate, though, was for $2.39 billion. This is on JP Morgan. The fixed income sales and trading. This is the bulwark of what the street is going to focus on. We've got a number here of fixed income sales and trading, 2.04 2.04 billion. The estimate was for 2.32, so that is just a small skim lighter. Fixed income, FICC sales and trade revenue on the overall revenue side, 5.01 billion. So this is a blowout at the top level on the trading revenue, $5.01 billion. The estimate was for 4.37 billion. You had the election, you had good forms of volatility. FX volatility is ratcheting. It did the morning after the election. So a blowout on FICC. Diamond says unemployment remains relatively low, and this is the core to the bifurcation within the consumer. So a blowout at the top line on FICC are the details. I know that you're sitting there with Shonali and you'll go through them. Let me just give you the credit losses, 2.63 billion. So there's a couple of lines coming through. I'll hand it back to you with Jamie Dimon comments in terms of the flow and the health of the U.S. consumer. Jonathan.
Manus, thank you. Appreciate it. Wells Fargo up in the pre-market. JP Morgan as well. JP Morgan higher by about 2%. Shonali alongside us to go through this. Shonali, what stands out to you?
A few things. From the Wells Fargo perspective, just pointing this out, because one big question has been loan growth, and they are expecting a growth in that NII this year alone. For JP Morgan, it is interesting. Fixed income, blowing it out of the water, up to $5 billion for the quarter in fixed income and currencies trading over here, but you do have equities falling light of expectations. Now, what does that look like into this year? There's an expected IPO rebound that would lead to more supply here for the trading desks, but they are below expectations. Competitive business right now on Wall Street. Goldman is looking to take more share. They're looking to finance hedge funds in order to build that business even bigger. Morgan Stanley has been the king of the castle there, reporting tomorrow. We'll see what that rat race looks like. Charge-offs in line with expectations. At this part of the cycle, that's good news, isn't it?
Both stocks trading higher in the pre-market, not just about the numbers, also about the commentary. Manus was talking about it from Jamie Dimon of JP Morgan. The US economy has been resilient, unemployment remains relatively low, and consumer spending stayed healthy, including during the holiday season. Businesses are more optimistic about the economy, and they are encouraged by expectations for a more pro-growth agenda and improved collaboration between government and business. However, two significant risks remain. Ongoing and future spending requirements will likely be inflationary, and therefore inflation may persist for some time. And additionally, Anne-Marie, geopolitical conditions remain the most dangerous and complicated since World War II.
You can expect that from Jamie Dimon, who not just wants to be a bank CEO, but also likes to really opine about what's going on in the world, talking about the geopolitics, where we're going into a year where we still have two hot wars. We're going to have also some potentially tit for tat when it comes to trade, when it comes to China. And this idea of inflation higher, if you are a consumer, and even if you're in a University of Michigan, Democrat or Republican, you think expectations are going to be higher, that means this could end up being a self-fulfilling prophecy. But for these banks, Jamie Dimon previously, not in this earnings report, but previously said how they viewed Trump's victory was bankers, Jonathan, dancing in the street.
Stock is up by 2% this morning. Gerard Cassidy of RBC alongside us. Gerard, let's start with JP Morgan and look at FIG. Good. Equities, not so much. Gerard, what explains that?
I think, Jonathan, it really drives right to your comments a little earlier about what's happened to the 10-year government bond yield. I think what you see in trading is increased volatility leads to better trading results. And when you think about how the 10-year has behaved since the Fed started cutting rates back in September, that is, I think, a contributing factor. But also, the steepening of the yield curve also helps. But I think it's the volatility that drove the FIC numbers. And the equity markets, and the trading was a little light there, as you pointed out. And really, the trading, the equity markets, going into the end of the year, really didn't have the robustness that we saw throughout the year.
Gerard, can I go back to the comments from Jamie Dimon talking about a resilient U.S. economy, but bringing up fears both of geopolitics and inflation? It also rhymes with what we heard from David Solomon earlier in the week, saying that the economy is in a strong place, but it's fragile in this moment because of the same concerns. To how much are these comments tailored to an audience of one? How careful are these banking executives going to be, both in their statements and on earnings call, with the knowledge that perhaps it gets back to President-elect Donald Trump?
I'm not so much wondering if it's really directed toward the candidate or President Trump, but more these are global companies. I mean, big global companies, and so these types of uncertain times and unfortunate situations on what's going on in the Middle East and over in Ukraine really could have, if it really got out of hand, would really have a material impact on their global operations. But here in the United States, for the consumer on Main Street America, yes, we see it in the nightly news and it's very tragic, but it doesn't necessarily affect their day-to-day living. Inflation is far more important, impacting the consumer.
When it comes to regulation, though, and this idea of deregulation, the idea that Trump 2.0 is going to have a much lighter touch, especially in the banking sector, than, say, the Biden administration, Jamie Dimon talked about this, saying, regarding regulation, we have consistently said that regulation should be designed to effectively balance promoting economic growth and maintaining a safe and sound banking system. Gerard, how excited are the banks for this part, what they would call the good parts of Trump 2.0?
Very excited. I would suggest to you the resignation of the vice chair of safety and soundness last Monday. Michael Barr was a very positive event to have regulation less onerous for the banks. Basel III endgame, which is what it's referred to, was going to force the banks to carry considerably higher levels of capital, even though at the outset, when it was being designed, it was expected to be capital neutral. Now with him stepping aside, we do think the banks could see a capital neutral Basel III endgame, even though the capital levels for the banks are well above what they need to be. So I think as you look forward, they're going to replace the head of the controller of the currency, the FDIC, the head of the Consumer Financial Protection Bureau, and now Barr as well. And you look at Trump's first term, he had people in those seats that were much more realistic and business friendly and bank friendly. And I think that's going to be the case the second time around as well.
Hey, Jared, appreciate your time, sir. Jared Cassidy there of RBC. Just getting the outlook, 2025, net interest income, 94 billion. The estimate, Shanali, 91.31. That is a nice upside surprise there and another tick higher in that stock.
Can I tell you something? The street was expecting this to be a lower number. So the fact that they came in at $94 billion expected this year. Guys, remember, this is a number that they have raised over and over and over again. This is the idea that you are not seeing interest rates lowering as much as expected, and you still have loan demand from consumers.
When we get this call a little bit later, 1/3 on the numbers, 1/3 on Trump, 1/3 on succession. Is that fair?
Yes, yes, and yes. Because one thing that has happened here with the Trump expectation is that, fine, lighter regulation means one thing. These companies have been hoarding capital in anticipation for those rules. So how much of that capital can be unlocked and how much of it goes right back in the hands of investors via share buybacks and dividends?
Shanali's going to stay close through the morning. A little bit later on, 35 minutes away, we'll get numbers from Goldman Sachs. After that, 30 minutes later, we should have numbers from Citi. Just getting numbers from JP Morgan in the last few moments. If you're looking at the trading side of things, FIC comes in strong, equities comes in light, but the outlook, Danny, the outlook looks pretty good.
The outlook does look good, and it's not even just net interest income. It's also a credit quality picture that's improving too. Both JP Morgan and Wells Fargo reported lower credit losses than estimated. So it overall looks like a bright and sunny environment.
Look out for the calls a little bit later. We'll see how bright and sunny Jamie Dimon's mood is on that call. The stock is up by 2.8% in the pre-market. Up next, Ken Leon of CFRA, Ed Yardeni of Yardeni Research, Jennifer Flitton of Invesco, and Greg Peters of PGIM, Fixed Income from New York City. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street